There's still a ton of uncertainty within the market to come.
The market just keeps moving sort of relentlessly higher.
Stay long the S&P. It's almost impossible to beat.
There's incredible dynamism, and investors want exposure to that around the world.
For the US to outperform from here, you essentially need to argue that we're going off, into the unknown.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
From New York City, for our audience worldwide, good morning. I'm Annmarie Hordern alongside Danny Berger. We have the changing landscape at the Fed, and it begins today. President Trump nominates Stephen Miron, the Council of Economic Advisors chairman, to fill Governor Kugler's seat as she steps down. This as Governor Waller emerges as the top candidate amongst the president's advisors to be the next Fed chair. And in the meantime, the market continues to digest tariff headlines. Japan is subject to stacking of rates, and gold bars from Switzerland, thought exempt, will now face levies, according to one report. Still, earnings fuel this equity market, and stocks are coming into Friday just shy, Danny, of a record high.
It's really remarkable that you can have headline after headline about Fed speculation, the tariff confusion, to your point, throw in a CEO getting chastised publicly by Trump, and stocks basically shrug it off yesterday. It feels like, Annmarie, that this is a market that has decided it is not going to price in any risk until it sees the whites of the eyes of the actual outcome. It is a we'll cross that bridge when we get there kind of market. Who's the Fed nomination? We'll cross that bridge when we get there. What are the outcomes of the tariffs? We'll cross that bridge when we get there.
And the problem with the outcome of the tariffs is that it is changing. Japan thought they had one deal. Now they're saying potentially the rates are going to be higher, especially when it comes to autos. Switzerland, the market thought these gold bars would be exempt. Doesn't look like that, according to an FT report. On the Fed, JP Morgan has a note out. New Fed governor, new Fed call. There is this thinking that it is going to be a more dovish Fed, even if it will be a Herculean effort to get Stephen Miron on the board before the September meeting, especially given the fact that the Senate is in recess right now. But still, the direction of travel, that this is someone who will line up alongside Governor Bowman and Waller when it comes to dissenting.
And I think the market voted in that way. You had a curve that steepened. You had a dollar that weakened. Some of that trade also, though, could be concerns of independence. But to your point, Annmarie, does it really impact the outlook if, one, he's just a temporary Fed governor, and two, you already had the crowd going that way? If he were to emerge potentially as the top pick for Fed chair, maybe that could change. But I think the best take came from Connor Sen, a Bloomberg opinion columnist, saying, hey, being a Fed governor seems really cool. It's like posting online without any consequences. It doesn't really matter.
It doesn't really matter, potentially. I think it will matter once they start getting a vote. And also, Nomura is talking about the fact that maybe we are at the end of this one-person Fed rule. And what does this mean for Jay Powell, who at the moment doesn't have the chairmanship next year, but has not told the president whether or not he is going to step down in his governor's seat. Markets this morning are edging a little bit higher, but as Danny and I have been saying, we are still shy of these record highs. No catalyst just yet in either direction. S&P 5 futures this morning up only 0.3%. Coming up this hour, Lori Calvasina of RBC, as stocks look to close out the week with gains. Adam Hodge of Bully Pulpit, as Trump says he is going to nominate Stephen Miron to the Fed. And Neil Dutta of Renaissance Macro, as Governor Waller emerges as the top contender to be the Fed chair. We begin this hour with stock steady as investors digest a busy week of earnings. Lori Calvasina of RBC writes that while economic developments dominated the headlines, we believe earnings commentary also provides some reason for equity investors to feel unsettled. Lori joins us now. Lori, I love the title of your note, Angst Returns. What is the angst right now in the market?
So it's interesting, Annmarie, as we've gone through this reporting season, we've, of course, gotten a number of, data points on tariffs and headlines and deals struck and that sort of thing. And it doesn't seem to matter what comes out of the administration. Every time I pick up an earnings call transcript and I read something about tariffs, the uncertainty point is emphasized. And I think what that speaks to is it's not just a question of the policies. I think that corporate America investors have wrapped their heads around the idea that tariffs are here to stay. I think it's also a question at this point in time, how does that filter through, not just with the rates themselves, not just with inflation, but also with demand, not just in 2025, but in 2026. Companies have been talking a lot about mitigation. Some of them have alluded to the idea that they're still figuring out some of those plans. So, I think we had a big shock back in the second quarter. Corporates reacted, and they're kind of coming back down to earth and digesting still.
Well, since the April lows of Liberation Day, the S&P 500 is up some 30%. It seems like investors have moved on. They think we're past that low of April. But it sounds like from corporate America, they're still nervous.
Right. I think there's definitely a gap or a disconnect between where the corporate psyche is and where the investor psyche is. And I think you can also argue maybe a difference between where corporations are and where investor sentiment or individual investor sentiment is as well. We've seen this big inflection in the market. We've seen inflections in things like NFIB, Conference Board, Michigan. If I'm reading these tones, frankly, there's been an inflection, but it doesn't sound to me like corporate America has had as big of a recovery. And that may just be because they are still very much mired in the details.
We have seen some really big reactions to earnings. You get a Palantir surging 8% after positive earnings. Eli Lilly crashing 14% after some disappointment on their obesity drugs. But those disappointments tend to be small with big reactions. Is it outsized this earnings season? Is that just anecdotal, or is something different going on?
This is tricky data. Like if you're trying to gauge the one-day price reaction, this is a tricky thing to go back and measure over time because of like the before market and after market phenomenon. But I have been joking with people. I spent a number of years as a small cap strategist, and it was routine, back in my small cap days to get 10, 20% moves on earnings, and it felt like, it was always more like 4 or 5 if it was extreme in S&P. We've had some stocks, Stanley, that have moved like 25%, 35% on earnings in very different sectors. So I think that you're seeing something about both liquidity. I think visibility is another thing. Those are issues that used to plague us in the small cap space, and I think that's filtered its way up into big cap right now.
So what difference does it make then if you have big caps that are swinging and giving you maybe PTSD of your small cap days, but a headline that's really sanguine? What does that mean with how you approach this market in terms of hedging and just judging where volatility goes?
Well, I like to joke also. Forgive me, I'm a data nerd, so my jokes aren't funny. But
you're on Bloomberg TV. All data jokes are funny.
But I do think valuations always come home to roost. I think there's always a question, of what they signal in terms of timing. Obviously they can stay stretched for a while, but I have watched the industrial sector with great interest in this reporting season because generally I think they've been, fine but not fabulous in terms of their ability to move to manage through. But we are seeing a lot of stocks that are moving down. Maybe not some of those massive outsized reactions. This has been an extraordinarily expensive sector. Every time I update my valuation model, we look at the median PE, so not a cap-weighted PE, but a median PE, both relative and absolute, and it's somewhere between 2 and 3 standard deviations versus the long-term average going back to the late 1980s. And you contrast that, with other sectors like maybe healthcare, where the valuations have been a little bit reasonable. Things, they're dealing with a lot of the same issues, but different reactions.
How's the consumer names preparing right now?
So, there's a real disconnect in the consumer discussion. I was actually talking with some folks about this earlier this week internally. The financial companies, and we've written about this in our Pulse report, the last few weeks, is the financial companies, you read a credit card, you read a bank, and they're like, yay, the consumer is fine. Their delinquencies are low. All the stats are really good. We're really proud of the consumer, for not letting themselves get stretched. And then you read the food companies or you read some of these travel companies, and the composition of the spend is showing caution beneath the surface. So, if we want to kind of listen to these financial companies and they're like, the consumer's okay, it's like, the consumer's really not okay. They're not in terrible shape. They're actually, in very good shape from a balance sheet perspective. So they're weathering the storm, but the consumer doesn't feel good right now.
If they're under pressure, can these companies and all the earnings reports you dig through, can they raise prices?
Well, I think the industrial companies think that they can, and they sound a lot more confident on that. The consumer companies are much more squishy, and they are very conscious of the fact that the consumer is value conscious. I've been talking about that, when we write these earnings recaps, I feel like for like 3 or 4, quarters in a row, and it hasn't let up in this reporting season, just that value consciousness, that shopping around. Even seeing it at the high end, right? It's not just a phenomenon hitting the low end. So I think the consumer companies are much, much more wary about their ability to do that. The big question, Annmarie, is how much demand was pulled forward. I would say both with consumers and the more kind of industrial side of the economy. I don't think corporate America has a great handle on that right now.
Yeah, I think it was one of the chip companies that said, we have no idea how much of our demand was pulled forward. Does that mean that some of the estimates that they're giving are too optimistic? Maybe they're not really judging how much was pulled forward and how much things might drop off at the end of this year?
We sort of dealt with some of this stuff back in COVID, right? And, there was different dynamics, but, I do think that there is some risk to earnings on both sides, right? I think to the extent demand was pulled forward, maybe there are some air pockets coming. I worry about that in particular for the consumer area, where I feel like the consumer has sort of understood the inflationary pressures, kind of much better. It could be that some of these companies that thought they saw pull forward really didn't, and things are going to continue. We just don't know that either. And, I've tried to keep track of which companies are saying yes, pull forward, which companies are saying no, which companies, are saying we have no idea, which companies just aren't commenting. And it kind of feels like an even distribution so far.
Danny, it feels a bit murky. I know even individuals in my family, my sister started buying Christmas gifts because she was so nervous that the toys and the price hikes were going to be enormous, and even a new car, because of the concern about the tariffs. So what do they do the rest of the year? What are they spending on?
Right, wanted to make sure she had more than one doll to give out for Christmas, of course. But even someone like Tim Cook comes out and says only 1% of the 10% revenue growth we had at Apple was because of a pull forward effect. I actually don't even know how you can judge that. Are they asking customers who are buying iPhones, hey, are you doing this because you're scared it's going to get more expensive? So even when you have certainty in numbers, there's this murkiness, to your point, underlying it.
I think there's also an issue of inventory. So some of the transportation companies have brought up recently that they haven't seen, sort of like peak ordering. I'm not an expert on the transportation space, but it sounds to me like a lot of companies haven't put their orders in. And one of the toy companies, I have small children, so I pay probably too much attention to this stuff, but one of the toy companies actually warned parents on their earnings call to go out and buy some of the hot toys because they weren't going to be able to replenish the stock. Now, I actually went and checked out one of those toys, and it was more expensive than I wanted to spend on that particular item. But, it just sort of was a reminder to me that the kind of demand dynamics are complex, but also the inventory dynamics are pretty complex.
Christmas sounds fun at your house. Lori Calvasina, you're sticking with us. We're going to break down the new Fed governor coming up next. But let's get you an update at this time with stories elsewhere. Here's your Bloomberg Brief with Lizzie Burden. Hey, Lizzie.
Hey, Annmarie. Israel is poised to take over Gaza City as part of a final push to topple Hamas and recover its remaining 50 hostages, dead or alive. The decision to seize the Strip's largest city marks the biggest escalation in the 22-month-long conflict in an already devastated territory where the UN warned 500,000 people are starving. Elsewhere, President Donald Trump tapped Council of Economic Advisers Chairman Stephen Miron to serve as a temporary Fed governor through January 2026. Trump will continue to look for a permanent replacement in the interim, with the race for Fed chair still underway. Sources telling us here at Bloomberg that Fed Governor Chris Waller has emerged as a top candidate for the role among Trump advisers. And Intel CEO Lip-Bu Tan says that he has the full backing of the company's board as President Donald Trump calls for his resignation. Tan has reached out to the White House to clear up what he called, quote, misinformation about his track record. Writing in a letter to staff, quote, I fully share the president's commitment to advancing US national and economic security. And that should be my brief. Annmarie.
Thanks so much, Lizzie. We'll have more on that Intel story later in the program. Up next, though, more surprises for the Fed.
Governor Waller has really built up a really impressive track record in the last few years at the Fed. He's done a really good job having an independent voice, which I think ultimately is proving correct, that there isn't really much of an inflationary threat from tariffs.
Adam Hodge of Bully Pulpit International joins us next. You're watching Bloomberg Surveillance. Good morning. Welcome to Bloomberg Surveillance. I'm Annmarie Hordern. Equity futures this morning just shy of a record high. We still are in the green territory, but nothing really, even amongst all these headlines in the past 24 hours, able to break out this basically treading water we have seen in the stock market. Under surveillance this morning, more surprises for the Fed.
Governor Waller has really built up a really impressive track record in the last few years at the Fed. And I think he's done himself, a big credit recently as well, not succumbing to the tariff derangement syndrome that many others throughout the country, but particularly at the Fed, seem to have succumbed to. He's done a really good job having an independent voice, which I think ultimately is proving correct, that there isn't really much of an inflationary threat from tariffs.
Here's the latest. President Donald Trump tapping Council of Economic Advisers Chairman appoints Stephen Miron to serve as a temporary Federal Reserve governor through January of 2026 as Federal Governor Chris Waller emerges as a favorite for the chair position among the Trump team. Bloomberg's Mike McKee joins us now. So, Mike, first to Stephen Miron, what should we know about him?
Well, the interesting thing about him is on monetary policy, he's somewhat orthodox and what you would describe as pragmatic. He has spoken out against inflation last fall when the Fed was cutting interest rates. He was opposed to it because he thought they were too premature in giving up on inflation. Now, of course, he's parroting the Trump line, so it isn't clear whether he continues to be more hawkish on inflation or whether he would get on the board and take a very dovish view going forward. What he might be heavily involved in is regulatory matters because he has published work on how the Fed should be reformed, and he has proposed some significant reforms like letting every member of the Open Market Committee vote and letting state governors pick the regional Fed bank presidents. So there's a lot he could do, but he would probably have to stay on, and that's the question that's unanswered. Does he stay on, or does he just have a couple of months in the seat?
Is he a real temp individual or actually is in a trial period? Bloomberg's Mike McKee, thank you so much. Let's continue this conversation now with Adam Hodge of Pulpit International. Adam, I really would love to get from you whether or not you think this is going to be smooth sailing in the Senate, and could it get done before the September Fed meeting?
Well, it's good to be back with you all. I think, and also kudos to your Bloomberg for the get of the new Fed nominee day he's announced. I think there's a real question about whether the Senate will come back to actually hold confirmation hearings for him. But they're going to be a doozy. There's no question about it. I think you can expect some fireworks between Elizabeth Warren and some of the, on the Democratic side. We're going to ask hard questions about Trump's economic plans, the tariffs, and whether Mr. Miron will have that independence that we all want to hope and have at the Fed. That, I think, is going to be the big question. I think that will be the big part of the confirmation hearings. And the president has put pressure on Senator Thune, the Senate Majority Leader, to get his nominees passed tonight. So I wouldn't be surprised if that pressure ramps back up and maybe the senators come back a couple weeks early.
Adam, there's been much commentary over the idea that Miron or any of the Kevins, any appointment wouldn't have too big of a consequence because it is a committee, because one individual person can't fully sway them. That was the argument, at least from Bill Dudley, speaking to Annmarie and myself earlier this week. You, though, write that chipping away at the Fed's credibility will have lasting consequences. What is your concern at that chipping away?
Look, I think there are real concerns and questions about if the Fed is deemed to be making decisions that are in the political interest of the president and not based on the hardcore data. That presents real questions for this, the confidence that the global economy will have in the U.S. economy, and whether the decisions that we make, as the benchmark currency for the world, that the decisions that are made in Washington are truly in the best interest of the economy or in the interest of the president. We've seen this be a problem for economies that have injected more political pressure on their central banks. And I think it's right for people to question and to hope that the new nominees, whoever comes to serve on the board, whoever becomes chair, has that independence to do what's right for the economy. And I think that is something that the president and the White House should want. And let's hope and I think ask that this administration continues in that trend.
Well, as Mike McKee mentioned, some of the more, let's call it extreme of Miron's beliefs come from papers he wrote earlier, not on policy itself, but things on legislative changes happening at the Fed. For example, letting the president fire the Fed chief for any reason or any of the governors. But again, that is something that would necessitate legislative change. Adam, do you think that any of those are likely to happen?
I don't, because I think that the members of Congress and the Senate, for all of the talk on the political side about, whether the president can fire the Fed, you've seen members of the Senate, in particular, pour some cold water on that idea, because I think they recognize, quite rightly, that it would have damaging consequences on people's confidence and trust in the U.S. economy. So I don't see that happening in the next few months. I really don't.
Adam, thank you so much for your time this morning. Adam Hodge of Pulpit International. Lori Calvasina of RBC is still with us. Lori, this morning, JP Morgan has a note out, and they basically said a shakeup at the Fed means it's locking in interest rate cuts. What does it mean for the equity market?
So look, I think if you go back over time, really kind of since 2023, we've seen this dynamic where when the bond market is dialing up their expectations for cuts, it tends to give a little bit of a tailwind to the equity market, and small caps in particular on a relative basis versus large caps. So we have kind of looked to the back half of the year and said, we expect some choppiness because of seasonality, because of valuations, because of all this tariff stuff we talked about. But we have acknowledged the idea that cuts are coming one way or another. Maybe it's September, maybe it's December, maybe it's next year. The market's been baking that in. So I think anything that, the market can eventually end up with a, hey, this is good for rate cuts, that ends up bolstering the case for equities a bit.
So all this palace intrigue about what's going to happen at the Fed, does the market just not care anymore because it's baked in?
Well, I think that, Danny made a good point earlier. It has to kind of see the whites of the eyes, but I think the headlines change so much. And we just think about the past week, even with this Fed narrative, there have been so many different twists and turns. I think the market is trying to take a slightly longer term view and say, let me see how this pans out and then I'll react. And while that may not be what I'm used to for most of my career, where they tend to shoot first and think later, that actually probably is a pretty healthy dynamic.
It is interesting, though, because there was a slight reaction when we had our reporting out that Waller was emerging as a candidate for the Fed governor. And it was stocks got weaker. Yeah. To your point, this idea that maybe it's not as dovish as putting, let's say, Kevin Hassett at the Fed chief. But ultimately, in the longer run, what matters more for stocks? Is it getting those cuts or concerns about brand America and Fed independence?
Well, look, here I would say there's a little bit of a difference between U.S. investors and non-U.S. investors. And one thing we do in our weekly is we watch the EPFR flows where we can really parse that out. And you have seen more of a rotation out of the U.S. and into Europe if you look at European domiciled funds, for example. So let's watch that news flow out of Europe. But look, I would say at the end of the day, the tricky spot for me is really why would the Fed cut, right? And after we got that NFP report, it felt like we had a case for a weakening labor market that was spurring those cuts. And that's a really interesting debate, right? Because investors on the equity side have generally wanted their cuts alongside a healthy, resilient economy without too much damage. So if you start to see some further evidence of erosion in the labor market, are the Fed cuts going to be enough? We'll have to see. My guess is that's something that contributes to volatility in the next few months.
By the way, speaking of flows, there was that weekly Bank of America note out from Michael Hartnett, who noted that you started actually now to see outflows from equity funds. I think it was just under $30 billion, and that go into safer money market funds. Has something changed in the psychology of the investor in recent months that they're less willing to continue to chase new highs during the summer melt-up?
No, it's a great question. And look, I haven't had a chance to digest that new EPFR data because it comes out at night, and I think he's in Europe, so he has a leg up on me, which always drives me nuts. But the reality is, if you look at just how the trends and flows have been recently, that U.S. equity flow just all in has been weakening. And it actually was incredibly strong last November around the election. We've seen both U.S. and non-U.S. investors pulling back, but we're getting into a stretch of the market that's not only weak seasonally from a performance perspective. We actually went back recently and looked at the dynamics of U.S. equity flows on a seasonal basis, and this is also a pretty weak seasonal time of year. So this is the time of year when you would start to see that kick in, frankly, regardless of the news flow.
Right, and it's converging with a tremendous amount of news flow and uncertainty in Washington. One thing we have heard from people is the concern internationally about the gold standard of the data, the fact that are these institutions independent. Do you think that at the margins that's chipping away at U.S. equity markets?
Look, I will say as an equity strategist, right, like I'm not on the front lines of this discussion the way my rates and my econ teams are, but I have personally, just come to the conclusion that in the post-COVID environment, number one, survey data is just a little wonkier than it used to be. I'm not sure if that's borne out by the data, but that's what it feels like to me. Maybe we're just all being more sensitive to these revisions and all just more aware that people don't fill out surveys. I also think that since COVID, we've really lucked out in the equity community because we had this explosion of alternative data sets, that are produced by banks, that are produced by private kind of third-party enterprises. We have a preponderance of data to look at, and that's really what my job is not to look at any one data point, but to look at all of the data and see what direction it's pointing in. And I think investors have kind of gotten used to that already. Not to say these issues don't matter, but I think there's bigger context.
Lori, thank you so much for your time this morning. Lori Calvasina of RBC. Coming up on the program, we're going to be speaking to Samuel Charap of RAND on a potential Trump-Putin meeting. Plus, Yahira Anand with your morning movers as Expedia soars on strong travel demand. We do have equity futures this morning, slightly up this Friday morning, going to close out the week higher. But again, just treading water in this very uncertain environment. You're watching Bloomberg Surveillance. morning. Welcome to Bloomberg Surveillance. I'm Annmarie Hordern alongside Danny Berger today, John and Lisa on some much-deserved time off. This morning, as Jonathan would say, no drama in the equity market. We are just shy of all-time highs. Really this treading water. Markets have these knee-jerk reactions, reacting to headlines, but then pretty much settle down to where we are. We are up on S&P 500 futures 0.3%. We are 3 hours away now from the cash open. Let's get your morning movers with Yahira. Hey, Yahira, good morning.
Good morning. You and Danny were talking about those big post-earnings moves. Well, I have 3 stocks underscoring that trend, and we start with Expedia, soaring 17% after it raised its full-year outlook as they see a demand recovery specifically in the U.S. The CEO saying that since the beginning of July, they've seen a tick up in travel demand, not just internationally, but especially in the U.S. And that is very similar to what we've heard from other airlines and other companies saying that July did provide a turning point for the U.S. consumer. Moving on to another consumer bellwether, that is Instacart. Shares are also soaring, up 13% after it posted its fastest order growth since 2022 for the second quarter in a row. And this is because it's been making changes to entice those price-conscious consumers, like providing lower minimums for free delivery. It's working, and it's just another sign after we heard from Uber and DoorDash that consumers are willing to pay for convenience. But what they're not willing to pay for is those $20 salads, and that is hitting Sweetgreen hard this morning, down 26%. Wow, the salad chain slashed its sales outlook after a second straight quarter of weak results, and they're saying that budget-conscious consumers are trading down to cheaper options, underscoring what Lori just told you guys, that the consumer is proving to be very value-conscious. Annmarie?
Wow, Yahira, that's a big number down. Not so sweet this morning. Thank you so much for that. On our radar this morning, President Trump nominating Stephen Miron, chair of the White House Council of Economic Advisors, to serve on the Fed's Board of Governors. Miron would serve the remainder of outgoing Governor Adriana Kugler's term, set to expire in January. And pretty much, Danny, the market was expecting someone that was going to be a Trump ally. The big question is whether or not, is this really temporary, or potentially could this be someone that stays at the Fed?
And that's going to make the difference, because if it is temporary, it was an FOMC that was already starting to come around to a dovish idea. Daly, for example, talking about the need to cut rates. So just one other voice to that dovish choir doesn't really matter, and if he maybe can't even get nominated until October. But you are right, Annmarie. If he is nominated as the chair, that changes the conversation, considering this is someone who has very specific ideas about overhauling the Fed and really has written the economic backbone for Trump's trade policy.
And we're going to get more on what this all means with Neil Dutta in the next block. And Neil Dutta has been very optimistic that potentially Governor Waller would then take the top post. And we have reporting that at the moment, that is the individual advisor telling Trump would be the best person to fill Jay Powell's shoes. And tariff uncertainty persisting this morning. Gold futures are surging to an all-time high after the U.S. put tariffs on gold bars, the move threatening to upend trade flows from Switzerland and other key refining hubs. On top of that, the U.S. confirmed it would end stacking of universal tariffs on Japan and cut car levies under the stacking system. The 15% tariff rate applied to Japan was being added to existing levies on its products. U.S. officials expressed regret and will refund any overpaid levies. If you're keeping up, congratulations. I was confused this morning.
There is so much confusion, and it's just part of the way that these deals have been done, that you get the top line agreement first, then the details later. It's something that you've been really good at pointing out, Annmarie. But in some ways, I wonder if this does leave the U.S. with continued leverage. Because you have this uncertainty, if these countries are doing something the U.S. doesn't like, do they retain pressure that they can keep on their allies? Every delay, a reminder that the finer points, the benefits really hinge on keeping Washington, D.C. happy.
And with a lot of these countries, they're still almost in negotiation. And with Switzerland, they definitely are. I mean, individuals like Japan's top trade advisor was in Washington, D.C. yesterday. So a lot of these conversations, the devil's in the details, as Danny just said. Now, we want to get to top stories worldwide. Israel is preparing to take control of Gaza City as part of a final push to topple Hamas and recover its remaining 50 hostages. The decision marks the biggest escalation in the 22-month-long conflict. Bloomberg's Mark Champion joins us now. Mark, what can you tell us about what Bibi Netanyahu is planning to do?
Well, I mean, he has said that he wants the armed forces to go in and take Gaza City. It's the remaining kind of quarter of Gaza. The rest of it they already control. The point here is that they've avoided it, and primarily because it's where they believe the remaining hostages are being held. So they didn't want to precipitate their deaths. Now what Netanyahu is saying is basically we need for a third time really. This is a third attempt at finishing off Hamas and getting it done. And then he has said we would then withdraw. But we would remain in control of security. An Arab force would come in. But what he hasn't done is to agree to any of the terms on which the Arab nations have said that they would come in, rebuild Gaza, take responsibility for it. So, in fact, specifically, he's ruled those out. So it's really not clear. He says that Israel does not want to permanently occupy Gaza. It's just going in to, deal with the hostages, deal with Hamas, and then, someone else would take over. But, unless he agrees to terms that he can come to agreement with terms, then we are looking at a more permanent occupation, which has, very severe implications both for Palestinians and for the region.
Even if he did agree to terms, Mark, who possibly could even take over oversight of the region? Is there a credible alternative at this moment?
Well, there are proposals that the Saudis, the UAE, Egypt, and so on, they're all, ready to get involved. Certainly they have the money. What they want is for the Palestinian Authority to move in and replace Hamas. This is something that Netanyahu has ruled out. They want, an administration. There would obviously be a quite substantial international administration alongside the Palestinian Authority for some time. There are, a lot of details to work out and some flaws in the plan. The primary one being, what do you do to disarm Hamas if it has not already been disarmed or hasn't agreed to do so? But these are things that potentially could be worked out, but it doesn't look so far that Netanyahu is interested.
Mark, thank you so much for your time this morning and the update on what is going on in Israel. Bloomberg's Mark Champion. Sticking with geopolitics, President Trump says he's willing to meet with Russian President Vladimir Putin, though the White House previously said he would not sit down with Putin before the Russian leader agreed to meet with President Volodymyr Zelensky. Samuel Charap of RAND joins us now. Sam, what do you make of all this? Do you think a meeting will actually take place? And what do you make of the about face from the White House, whether or not they're going to sit down with Putin, depending on if he sits down with the Ukrainian leader?
Well, I think it seems like the momentum is moving towards a meeting as early as next week. That does seem to be what both the Kremlin and the White House have indicated. As for the question about whether it was conditioned on Putin's agreement to do this in a sort of trilateral format with Zelensky and Trump at once, the rumors are flying quite wildly right now, and we're really in a sort of information environment where you hear one thing from White House sources in the middle of the day, and Trump comes out and says the opposite at the end. It's unclear the extent to which this meeting has the kind of infrastructure in place that one would normally expect from a presidential level summit on a quite sensitive issue. So I think a lot of the details are being worked out as we go along here.
Usually a summit is the final lever that's pulled in a negotiation, and it's basically to sign an agreement that work for months already went into. Does this feel like this summit is actually the start of that process?
I think if the meeting does happen, I think the best we can hope for is for the leaders to agree to begin a process. Now, I'm not sure that that's where Trump's mind is at. I think he sees the power of his own personal diplomacy as being, definitive in these kinds of interactions, and that I'm sure he's hoping for a concrete outcome like a ceasefire from this kind of meeting. I think that, the prospect of the war coming to an end next week is pretty, improbable at this point. So, whether Trump's expectations and the realities of how these kinds of interactions have worked in the past can be reconciled is an open question. But I do think that the most really one can expect out of a meeting like this, given the intensity of the ongoing conflict and the really knotty issues involved in resolving it, is an agreement from the leaders to begin a process in earnest that could, over time, we're talking weeks, months, produce an outcome like a ceasefire or a broader settlement.
Also notably, Sam, it's not a meeting that's just going to be missing President Zelensky, but really any European representative. And this is something in the past that the Europeans have loathed, that a decision potentially is being made without their input. Is there a real risk that a meeting between these two leaders could sway President Trump into pushing for an outcome that is more favorable to Russia and President Putin?
Well, I think that both the Europeans and the Ukrainians are concerned, and many others, presumably, that, if Putin were to give Trump some concessions or ask for certain conditions that Trump finds acceptable, but the rest of the world or the rest of Europe and Ukraine do not, such as international recognition of Russia's annexations in Ukraine, in return for a ceasefire, that he might go for it and then sort of demand that Zelensky agree. I think the reality is that Putin's demands are quite comprehensive, and they're ones that, I think Trump is going to have a hard time swallowing whole. They're going to have to be hammered out over time. So I think while that fear is there, it does seem to me unlikely that it's going to be the kind of thing where Trump can say yes to something that Putin would then say, okay, well, that's enough, I'm done. Ukraine's going to have to be a party to it in the end. You can't do this to the Ukrainians. You have to do it with them because they are the ones doing the fighting, and ultimately they have a say whether they're at the table or not and whether a ceasefire holds. I think there are concerns, but ultimately the Ukrainians are going to have to be part of the picture, and the Europeans too. They have equities here. They have sanctions regime is they're a key part of, and their assistance to Ukraine is obviously central to Ukraine's future.
Very quickly, Sam, you mentioned what's going on with the Europeans. Does the U.S. and the EU need to be aligned in order for this to work?
It would make it a lot easier, given that they are the key actors together and have been since the beginning of the full-scale invasion in February 2022, in both applying pressure to Russia together, at least in the past, and in supporting the Ukrainians, and Ukraine's future being on an EU membership path. Obviously, that puts the Europeans in a position of sort of decisive, being a decisive actor. So the fact that US-EU relations are in the state that they are makes this a whole lot more complicated. It would be much better for the purposes of this negotiation if Trump were speaking for a sort of united West, but that is obviously not the case right now.
Samuel, thank you so much for your time this morning. Samuel Charap of RAND, and he recently has a piece out talking about how peace negotiations in Ukraine haven't failed. They haven't really started, which everyone is looking at this meeting. Is it the end of this agreement or really the beginning of just a new process? Let's get you an update on stories elsewhere this morning we're tracking. Here's your Bloomberg Brief with Lizzie Burden. Hey, Lizzie.
Hey, Annmarie. The US confirmed that it would end stacking of universal tariffs on Japan and cut car levies. Under the stacking system, the 15% tariff applied to Japan was being added on existing levies on its products. Officials expressed regret that the stacking rule had been applied to Japan despite a verbal agreement, and said that Washington would refund any overpaid levies. Elsewhere, Meta has picked PIMCO and Blue Owl to lead a $29 billion financing for its data center expansion in rural Louisiana. Sources telling us here at Bloomberg that PIMCO is expected to lead a $26 billion debt portion of the financing, while Blue Owl is providing $3 billion of equity. Representatives for Meta, PIMCO and Blue Owl declined to comment. And OpenAI is rolling out its new AI model called GPT-5, which is designed to be more capable at coding and creative writing, as well as reasoning through complex queries. CEO Sam Altman called the new model a major upgrade, saying it really feels like talking to an expert in any topic. It'll be made widely available to all free users. And that's your Bloomberg Brief. Annmarie.
Thanks so much, Lizzie. Up next in the program, the race to replace Chair Powell.
There is a very strong culture and ethic at the Fed to make decisions divorced from political pressure or political considerations. That culture is very strong at the Fed.
Neil Dutta of Renmac joins us next. You're watching Bloomberg Surveillance. Good morning. Welcome to Bloomberg Surveillance. Equity markets futures higher this morning, looking to close out the week in the green, but still shy of record highs. The market is digesting a ton of headlines, not just what's going on in tariffs and will there or will not be tariffs stacking in Japan or tariffs on gold bars, but also what is happening at the Federal Reserve. And that is under surveillance this morning, the race to replace Chair Powell.
I think there is a very strong culture and ethic at the Fed to make decisions divorced from political pressure, political considerations. That culture is very strong at the Fed. There'll be an onus on whoever the chair is to uphold that ethic. And I know Chris Waller, for example, would.
Here's the latest. President Trump has nominated Stephen Miron to serve the rest of Fed Governor Adriana Kugler's expiring term. Sources telling us that Fed Governor Chris Waller is a top candidate to replace Jerome Powell as Fed chair among Trump's team. Neil Dutta of Renaissance Macro writes, I've long believed Waller achieves the president's aims. The risk with anyone else is that they potentially keep Powell in place and end up being a chairman in name only. Neil Dutta of Renmac joins us now. So, Neil, basically what you were saying is that if the Trump administration wants to make sure Powell steps aside, they have to go with someone like Chris Waller. Do you think Powell would actually stay if they go with another name?
Well, I mean, I don't know. Obviously, it would be unusual, but nothing about the process so far, Annmarie, as you would probably tell, has been usual. So, I do think that Powell has one card, his trump card, so to speak, and he's keeping it very close to his chest.
Here's another card. Breitbart's John Carney says potentially there's still a chance for Bessent to become Fed chair. The current Treasury Secretary, quote, if Bessent moves to the Fed, someone will need to carry the Treasury portfolio forward. The obvious choice is Larry Kudlow. He already knows the job from his time at NEC director. Neil, do you just maybe guess that this administration is trying to have strategic ambiguity and lots of optionality when it comes to what they plan to do next year?
Yeah, I mean, Annmarie, I don't do palace intrigue. Secretary Bessent has said repeatedly he doesn't want the job. He has the best job in D.C. Obviously, they make musicals about the Treasury Secretary, not the Fed chair. But, stranger things have happened. Obviously, we all know how the sort of Trump horse race works. I mean, at one time, it was possible that Kevin Warsh was going to be Treasury Secretary en route to being Fed chair. So there's always this sort of up and down with different people, whoever has the presidency here most recently. And, you can't rule it out. Obviously, Christopher Waller, this article came out this week. I mean, I think you can make an argument that even though it's encouraging, perhaps he's peaking a little bit too early in the horse race.
Neil, it took me way too long to realize you were talking about Hamilton, by the way. I was like, did someone make a...
Maybe Larry Kudlow wants a musical.
Yeah, Larry Kudlow, the musical. I'm sure tickets will be flying off the shelves. Neil, let's say that some of this palace intrigue are trial balloons to see how the market reacts. What has been your judge in how the market has reacted to some of these names being thrown out?
Well, I mean, I don't think that there was much market movement with Steve. I mean, I think, it's going to be very difficult for one person to kind of affect sweeping change. And it's not even clear that, this will be his seat after the 3-month term is up. And it's not clear exactly when he'll get seated. So it's really difficult for one person to have that much sway in an institution that is built off of consensus building. So, I mean, I think if you had to put a magnifying glass to it, I mean, I thought it was interesting that, the back end of the yield curve moved down a little bit when Waller was kind of moving up and yields rose a bit more when Hassett was moving up this week. But, that might be also stretching for a narrative on my point, on my part.
Fair enough. And it's a Fed that's built on consensus building. Neil, going back to your original point, if it is a Powell that stays on, Does he and will he have the power of being that shadow Fed chair of sorts? Would he stay on and continue to consensus build and try to lead the Fed in a direction, even if he's not the chair?
Well, I mean, he would be there as a check. I mean, again, this is pure speculation, right? I mean, it would be, again, a very unusual thing, but I stress that nothing about the process has been usual. So, if at a minimum, he shouldn't be giving any signal about his future plans until the president nominates his replacement.
We have a nomination yesterday, Neil, when it comes to Kugler-Seeks. I want to get your thoughts on this. Less than a year ago, Stephen Myron was talking about the fact that the Fed shouldn't be cutting because GDP growth was 2.5 to 3%, where we are now. The labor market is stronger than the doves think, and underlying inflation is running 2.5 to 3%. So do you think that the market is just going to purely look at him as political?
Well, no. I think, Steve is a top-notch economist, and he knows what he's doing. I obviously I disagreed with him last year on rate cuts. I thought the Fed was right to do a large upfront move, given the cracking in the labor market, and I think they're right to cut now as well. I think what Myron would argue would basically be that the supply side of the economy is expanding, and part of that could be driven by a deregulation agenda, increased capital investment, and that's probably what's and the fact that inflation's been coming in generally weaker than expected for the first half of the year. Those things probably lead him into the direction of a cut. With me, my concerns are primarily about the ongoing cooling in the job market and the weak growth in nominal incomes, nominal GDP in the first half of the year.
A lot of guests will come on the program and say, it's really not weak, it's just a freeze because we've had all this uncertainty. What's your response to that? Because you really think we have a weak labor market.
Yes, I do. Look at prime age rates of employment. They're down 0.5 percentage point against last year. That is a very unusual situation. If you look at the breadth of employment growth, it's basically at stall speed. It's consistent with stall speed. You basically have barely half of the industries adding work. There's also additional weakness in the pipeline because we know that the housing market is slowing down. And builders are rationalizing their business models and aligning construction activity to their sales, which have been weaker. That means that they're going to need fewer construction workers going forward. So despite all this talk about how immigration is kind of, stealthily tightening the job market, if you ask builders about whether they can find workers, they have no problem sourcing labor, which means that demand is cooling off. I think that there's more downside ahead, particularly in goods producing industries. If companies, generally speaking, are a little bit more concerned about their demand outlook, they're not going to be hiring as much or investing as much. The Conference Board put out an interesting survey of CEO confidence. And while CEO confidence recovered, not surprisingly because the markets have recovered, you still have a large number of CEOs, the highest since the fourth quarter of 2020, telling you that they plan net reductions in their workforce over the next period of time. So to me, I think the labor market are on very thin ice.
Neil, and you've been very consistent about that. Neil Dutta of Rudnick, thank you so much for joining us. Coming up in the next hour, Savita Subramanian of Bank of America, Monica Guerra of Morgan Stanley, former Senate trade advisor Bruce Hirsh.
The economy has been kicking along. Things have been going well.
Policy right now is still restrictive. We are seeing signs that the labor market is slowing.
The FOMC is under tremendous amount of pressure.
It's very likely that we will see some easing.
We are expecting a cut in rate in September now.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
From New York City for our audience worldwide, good morning. I'm Annmarie Hordern alongside Danny Berger. John and Lisa are off today. The changing landscape at the Fed begins today. President Trump is nominating Stephen Myron, the Council of Economic Advisors chairman, to fill Governor Kugler's seat. She steps down today. She was supposed to step down in January. This all comes as Governor Waller emerges as the top candidate amongst the president's key advisors to be the next chair. And in the meantime, The market continues to digest tariff headlines, scratching their head. What is going on? Japan is now subject to stacking of rates, potentially. And gold bars from Switzerland, from one report, are thought to be exempt. We're now potentially going to be facing levies. Still, earnings are fueling this equity market, and stocks are coming into Friday just shy of a record high. Danny, there's a lot to get through today. You think we can move past the tariff uncertainty, and then you have things like Japan, confused about what's happening with these rates. Switzerland, potentially those gold bars that have been coming to the United States. Maybe they have to pay even back fees, which is why you have changes in the gold market in New York and what's going on in London. And then all of this amidst basically a changing of the guard at the Fed.
And all of this and a market that shrugs and goes, whatever, we can handle all of this. It is a market, though, that is maybe, to what Lori Calvasina said, has changed from a market that's shoot first and ask questions later to ask questions first and then shoot. Maybe it's a healthy change, but Annmarie, what we have seen is on a headline level, a market that's really sanguine. I gotta say, some of these moves off the back of earnings have been huge. Expedia today, yesterday, it was companies like Lilly. The day before, it was Palantir. So there are big moves happening. But again, on that surface level, it feels like everything is calm and just shrugging things off.
And Lori Calvasina, who does a great job going through every single earnings report, is basically saying, I still see the angst. We haven't moved forward. But amongst this, the market is also pricing in the fact that we're going to have a more dovish Fed. JP Morgan, new note this morning, new Fed governor, new Fed call. Basically, the direction of travel at the Fed is going to be an inclination to cut rates. I love this, though. Getting Myron approved by the Senate after it gets back from recess on September 5th, but before the next FOMC meeting starts on September 16th, would be a Herculean task. They do note, though, no one thought the one big beautiful bill can get done before July 4th and signed into law. So potentially we will have another dissenter in September.
But does it matter, I guess, is the question. If already we're having a lot of Fed governors coming around to the idea of cuts, I do think there was a little bit of irony yesterday when Waller got floated as a name through our excellent reporting here at Bloomberg News that Waller could be a top contender. And you actually saw stocks weaken just a touch. But they did weaken on this idea that if you get a Fed governor who's a Waller, he's maybe not as dovish as a Kevin Hassett, for example. Bond markets, though, clearly voted in the favor of Waller and not in Myron. So there is a disconnect, it seems, between the two markets and how, at least in the short term, how they react to the palace intrigue of the next Fed governor.
And we begin this Friday morning, with stocks moving just a little bit higher, but really just treading more water. How many times have we said we're just shy of a record high? We're just shy. Well, that's exactly where we are. Michael Hartnett, though, has a note out saying investors are pulling money from U.S. equities and flocking into cash funds. That's something we're going to be talking about coming up next. We do have Savita Subramanian of Bank of America on why sentiment is just not euphoric. Monica Guerra of Morgan Stanley as Trump chooses Stephen Myron for the Fed governor spot, and Kelly Kowalski of MassMutual looking for a September rate cut. We begin this hour with S&P 500 set for a weekly gain. Savita Subramanian of Bank of America writing, sentiment is far from euphoric. The consensus Wall Street broker is recommending an average allocation of just 56% to U.S. stocks. This is not euphoria. Savita joins us now. Thank you so much. Good morning. Thanks for joining us. So if it's not euphoria, what are we in right now? What is this world?
Yeah, this world feels weird, but I think we're in that sort of wall of worry stage where there are certain themes that are getting a lot of credence and credibility, like AI. Other themes are kind of falling out of bed, like GLP-1. And then you've got this potential broadening of the market that we've all been waiting for with bated breath that I think is at a moment where it's actually in the works. So if you read the transcripts, and I love Lori's quote, but I think that when you read the transcripts, companies are worried, but they're also talking about the fact that they've delayed a lot of projects. They haven't canceled them, they've delayed them. That means there's a lot of pent-up activity, business activity in the pipes that is likely to be unfurled over the next couple of quarters. And I think what really stymied that pickup in broadening and kind of other companies actually moving from, their very low multiples and low levels is the idea that we're past a lot of the tariff uncertainty. I mean, granted, there are curveballs that are thrown at us every day, but we do know what's going on with Europe. We've got a better handle on how companies can actually plan and do business. We're also starting to see, I think, the beginnings of this M&A cycle, even cross-border M&A. So I think those are other animal spirits that could unleash a broader pickup in economic activity. And then when we look at things like, companies reporting, I think what's really noteworthy is that at this point, about 80% of companies have beat on revenue. That's new. We haven't seen this revenue surprise in a while. So what that means is that analysts marked down expectations very low for sales and demand, and they're beating those lowered expectations. So I think this all bodes well for a broader market. I would stick with large cap value stocks, companies that are, really in the penalty box, but could actually start to work in an environment where, we do see earnings broaden in a bigger pickup.
What happens if you add in rate cuts to all of that? Is that just jet fuel for the broadening out and even maybe for some of the smaller companies?
I think it's jet fuel for small caps. I don't know if large caps need a rate cut. I mean, the thing that I like about the S&P 500 is it's kind of immune to the Fed because a lot of these stocks really move more on long rates rather than short rates. So I think that, the refinancing risk is really firmly in the Russell 2000 rather than the S&P 500. But I do think that a Fed cutting rates from these levels would be sort of a driver for more positive sentiment on stocks, a shift out of cash into stocks. If inflation remains high, I think there's one pocket that the bulk of individual investors have to go to. So think about individual investors that are mostly retirees. They're sitting in big tech stocks and cash. If cash yields are coming down, but inflation is still relatively high, what are you going to do for real yield? This is where I think that dividends, cash return, et cetera, come in. What worries me a little bit about the big ballast of the S&P 500, the AI spenders, is that these guys are becoming more capital intensive. And that might not be great for multiples, for cash return, et cetera. In fact, we wrote a note this morning highlighting that the Magnificent Six, if you take out Tesla, is growing much more capital intensive and less R&D focused. And I think that's something to watch because we're sort of in the middle innings, I think, of an AI spend cycle. And if that continues, the asset lightness of these mega cap tech stocks is potentially compromised.
Your note you have, we are moving from, quote, everyone spending on tech to tech spending on everything. Danny,
Exactly.
This has been a story of the entire quarter.
Yeah, it has been the story, and it's been a lot of the reason why it's hard to be bearish. But I do think this idea of the business model changing is so interesting, Savita, because part of the thing that people bought tech for was because they were capital light and you could get those really high valuations.
And great growth.
Great growth.
And free cash flow.
So is there now a ceiling, or will there start to be a ceiling on multiples, on valuations, if it's a different business model and all of a sudden they're capital intensive?
Well, I think you need to see the revenue beats for these companies because if you don't see top line really accelerate along with CapEx, you're cutting into that earnings, you're cutting into that free cash flow. We've already seen the total shareholder return for the Magnificent Six drop since 2015. We've seen CapEx to sales pick up. We've seen R&D to sales decline. It's all happening. The question is, when will it get priced in? Because these stocks are trading near their all-time highs in terms of multiples. I think what we start to see is a trade-off where old economy stocks are getting all these new tools to get more efficient, asset-light, labor-light, et cetera, whereas tech companies are starting to get more asset-intensive. It's a very sort of slow burn shift or handing off of multiple expansion to multiple contraction, but I think it's something to keep an eye on.
When it comes to policy, we have the one big beautiful bill.
Yes.
There is a little bit more of an understanding what's going on with tariffs.
Yeah.
What are you waiting for out of Washington? What's the next shoe to drop?
I think right now there are not a lot of catalysts, and maybe, the Fed obviously, but I think that we're in an environment where our near-term outlook on equities isn't great. I mean, we think a lot of the good news is priced into the market. If you look at reactions to beats, they were pretty good, but reactions to misses were terrible. In fact, the worst downdraft to earnings misses and sales misses in the history of our data since Reg FD back in 2001. So this means the good news is probably more than priced in the near term. I do think if we see this broadening of earnings growth and we see a pickup in some of the economic indicators, maybe the Fed cut is compromised or a continued cutting cycle is compromised, but I think that's the driver for better earnings.
And you still think we're going to be at 6,300 year end?
So 6,300 is our year-end forecast. I think it's tricky because we've also got the midterm elections coming up. So our 12-month forecast, which is probably more important or relevant, is really for more like 5% gains from here. I think what's interesting, though, is that the years where you've seen the biggest earnings recoveries haven't necessarily seen the strongest market returns. So that's kind of what we're operating on, is the idea that earnings are coming back, we're exiting a manufacturing recession, but market returns aren't necessarily going to be blockbuster.
Savita, thank you so much for your time this morning.
Thank you.
That was fantastic. Savita Subramanian of Bank of America. Let's get you an update now on stories elsewhere this morning. Here's your Bloomberg Brief with Lizzie Burden. Hey, Lizzie.
Hey, Annmarie. President Donald Trump tapped Council of Economic Advisers Chairman Stephen Miron to serve as a temporary Fed governor through January 2026. Trump will continue to look for a permanent replacement in the interim, with a race to replace the Fed chair still underway. Sources telling us here at Bloomberg that Fed Governor Chris Waller has emerged as a top candidate for the role among Trump advisers. Elsewhere, Intel CEO Lip-Bu Tan says that he has the full backing of the company's board as President Donald Trump calls for his resignation. Tan has reached out to the White House to clear up what he called, quote, misinformation about his track record, writing in a letter to staff, quote, I fully share the president's commitments to advancing US national and economic security. And the US Customs and Border Protection Agency has clarified that gold bars are subject to tariffs, this according to people familiar. Gold futures surged to a record high in New York as traders are scrambling to understand whether the tariffs are already in force, if they apply to all countries, or how they might be avoided. And that should be my brief. Annmarie.
Thanks so much, Lizzie. And Lizzie will be back with us in the next 30 minutes. Up next, President Trump's latest surprise.
Governor Waller has really built up a really impressive track record in the last few years at the Fed. He's done a really good job having an independent voice, which I think ultimately is proving correct, that there isn't really much of an inflationary threat from tariffs.
Monica Guerra of Morgan Stanley coming up next. You're watching Bloomberg Surveillance. Good morning and welcome to Bloomberg Surveillance. John and Lisa are off today. I'm joined by Danny Berger. We're watching an equity market that's looking to close out the week higher. We're up 0.3% this morning, but we've really just been treading water. That's what everyone's been telling us. There's been a lot of angst when it comes to what Savita was saying, what Lori was saying, in terms of when you actually dig into corporate earnings reports and get on the calls with these CEOs. There's still this feeling of uncertainty in terms of policy in Washington, D.C. And I want to also talk about what's going on in the gold futures this morning. Gold futures up 0.6%. Danny, a ton of confusion on what the tariffs mean with Switzerland specifically, because they send a lot of gold bars into the United States. And one report saying actually those gold bars are going to have to face that higher tariff rate.
And the assumption was that they'd be exempt, even to the point where some people in this market told Bloomberg that they weren't even sure whether this was maybe just a mistake from the Customs and Border Patrol. I think one thing holds true, Annmarie, this clearly means we need an audit of Fort Knox. I'm upset we never got it. I want to see Trump and Jay Powell in hard hats at Fort Knox.
I did ask the Treasury Secretary about this. Did he have any plans at any point to be going to Kentucky? And he said no. And he said any senator can go and they can go check on it. And, you know, he was pretty emphatic that the gold is all there. But yeah, this is a good point. A little bit conspiracy theory, and I'm sure Twitter loves that, but a good point. Under surveillance this morning, President Trump's latest surprise.
Governor Waller has really built up a really impressive track record in the last few years at the Fed. And I think he's done himself, a big credit recently as well, not succumbing to the tariff derangement syndrome that many others throughout the country, but particularly at the Fed, seem to have succumbed to. He's done a really good job having an independent voice, which I think ultimately is proving correct, that there isn't really much of an inflationary threat from tariffs.
Here's the latest. President Trump tapping Council of Economic Advisers Chairman Stephen Miron, who you heard there just yesterday on Bloomberg TV. He will be serving as the temporary position for the Federal Reserve Governor through January of 2026. This is as Fed Governor Chris Waller, according to our reporting with Saleha Mohsen, emerges as a favorite for the Fed chair among the Trump team. Bloomberg's Mike McKee joins us now. So, Mike, what do we need to know about Steve Miron? Because I was just talking to Neil Dutta, Danny, and I in the last hour, and we brought up the point that actually Steve Miron just under a year was saying that the Fed would be crazy to cut rates, and now he seems to be a proponent of it.
Well, you got to figure out who he's working for now. That'll tell you perhaps why he is so dovish at the moment. The president has argued that his tariffs won't be inflationary, so Stephen Myron is arguing that the tariffs won't be inflationary. And so far, we haven't seen a big impact, but we get CPI on Tuesday, and it'll be very interesting to see if we get some tariff feed through. That's the question, is what is the economy going to look like, inflation and jobs, on September 17th when the Fed next meets? If there is a sharp rise in inflation, then the Fed is going to probably hold off again. If inflation is under control, then they may cut. And in either case, a Myron appointment, assuming the Senate could confirm him by then, which is unlikely, but a Myron appointment wouldn't mean a whole lot. And it just moves you out farther into the year by the time he takes office. And then we have to figure out where the economy is. He has in the past, as you said, argued for no rate cuts when the economy was, when inflation was rising. And now he's on the other side, in part because his boss is telling him to.
To that point, Mike, and what we've heard from Fed officials over the past week, is there a real and sustainable, more dovish shift that would make Myron's addition to that dovish choir less relevant?
Yes, although I hesitate to say sustainable. Right now, we've heard a lot of Fed officials this week come out and say that they think maybe it is time to consider rate cuts, although they qualify that by saying, let's see where the data take us by the time we vote again. But that has been the shift. Now, is it sustainable? That depends on what the data tell us. If we get a rebound in jobs in August, then you'll probably see people back off. If we have more of the same, then you'll bake in a rate cut. And again, it would make Myron's vote somewhat irrelevant. There's been some speculation that he would be a third dissent if the Fed held itself without doing another rate cut. The only thing there is that it really wouldn't matter very much to Jay Powell, because it would be seen as a vote politically motivated by the Trump appointee. So I don't think he's going to have a lot of influence in the short run.
He also needs to make sure he gets that Senate confirmation before the next meeting if he was to be a third dissenter. Bloomberg's Mike McKee, thank you so much. Let's continue the conversation with Monica Guerra of Morgan Stanley. Monica, do you think there's even a possibility he can be on the Fed by September?
It could be difficult, right, because they're coming back into session at the end of August. And there's a lot that they're already working on. So if you think about the Senate, they're considering the 2026 appropriations and budget bills. So while we just got through 2025 budget reconciliation, 2026 still needs to be confirmed. And that's at the front of order. So it is a tight window for him to actually get confirmed.
He's already been confirmed. It was a party line vote, though, 53-46. How difficult might it be for him this time around?
This time around, I think it's more about the timing and pace of the legislation, and if they do decide to actually table the activity that they already have scheduled. So for us, it is a matter of, I think markets are just waiting, right, to see if he'll actually get that confirmation. But he does get confirmed, yes.
People think he gets confirmed.
How much do you look at that, though, and judge how easy or difficult other nominees could be, especially less conventional ones, maybe one of the Kevins? Will it be instructive at all to say what happens from here for the Fed chair nomination?
And so I can't opine on the Fed musical chairs. I'll leave that to the economists. But for us, when we're thinking about the short run and what's happening in Congress, we're really focused on 2026 and moving that ball forward. So yes, fixed income markets are really interested in what's going to happen with Myron in the short term. In the short run, we know we're going to get there. It's just when. And then for us, it's where do we land on appropriations, and what does that mean from a fiscal stimulus perspective?
Speaking of where do we land, there's still a lot of confusion as to where we land with tariffs. Just the latest confusion has been, one, what's happening with gold bars, and two, what's happening with Japan. Are tariffs getting stacked? Is the U.S. taking that back? To what degree does that demonstrate that even when these deals and frameworks are reached, that the story's not done yet?
Yeah, the story isn't done, and I think you've heard that over and over again, over the last couple of days and weeks. So what we have landed with is significantly more clarity, right, with that 10% universal plus these additional tariffs. And we do see many of the tariffs being stacked. So that's my baseline assumption with Japan. Now with Switzerland, to me, when I think about gold, this becomes a story of diversification and really emphasizing the need to be diversified across your portfolios. It could come on, it could come off. We don't know the direction. The thing I always emphasize with our clients is that tariffs are not taxes. The reason why you couldn't have tariff revenues as a pass-through in the budget reconciliation bill is because they are so changeable. It's not a known payer base, right? It's something that can change and shift. So it really emphasizes that diversification story.
How are you thinking about the semiconductors, pharmaceutical, the sectoral tariffs we're still waiting to actually get details on?
Yeah, so we think that they're coming, and we think that they are a part of this broader growth narrative for 2026. When we're thinking about tariffs, just generally, everyone's thinking about cost levels shifting up. But it is also part of this negotiation tactic and the attempt to bring industry back to the United States and keep us competitive, especially in the tech AI innovation space. And so when we're thinking about growth, this is really a key part of that component. And so not only are we expecting increased tariffs on semis, but fiscal spending in the future.
But does it matter if everyone basically gets an exemption?
I mean, if everyone gets an exemption, it's on the heels of significant investment, right? So I don't think everyone's going to get it. I think it's going to be a trade-off, right? That if you are actually willing and it forces the hand to bring that manufacturing, that production to the United States, then it's fulfilling the ultimate goal of the administration, which is making the U.S. the hub for semis, having more control and national security component, even if you throw that into the angle, of our full supply chain around semis. So for me, this is completely a holistic narrative that makes sense.
Carrot and stick approach. All of this we've discussed. We haven't mentioned China. What's the status of this deal?
I mean, that's anyone's guess at this game, right? For us, we're continuing to expect this throughout the remainder of the year. So I expect negotiations ongoing. This is one of the areas where I've said over and over again that while we're going to get fast conclusion in other spaces, this is going to have the longest run. And that's because of not just how intimately integrated our economies are, but that trade deals of this magnitude take a long time, and people forget that. And so the fact that we've been running at this pace in the United States and cutting the deals that we've been cutting, these are at record pace. And so we have to take that in consideration. It can take up years in certain cases to get a deal done.
Monica, thanks so much for your insight this morning. Monica Guerra of Morgan Stanley. And Danny, you put it well, the devil's in the details. To Monica's point, trade deals usually take years. When you have them this quickly, well, there might be some chop along the way when it comes to some of the fine print.
Especially when what happens is the first thing you have is the two leaders coming together and you agree on the framework and not the details. To your point, Annmarie, it's usually the opposite order of what happens. So do you get this continued confusion down the road? It's hard to see any other circumstance.
Yeah, having covering both these administrations back to back, the Biden administration is very process oriented from the beginning. Trump, he wants the shock and awe from the beginning. You deal with the details later. And at the moment, for some trade, it's working out in his favor, but there's going to be potentially some chop along the way. Coming up in the program, former Senate trade advisor Bruce Hirsh to continue this conversation. Plus, Yahira is back with us with your morning movers, including Under Armour under pressure, down more than 13%. This is Bloomberg Surveillance. Good morning and happy Friday. I'm Annmarie Hordern. John and Lisa are off, much-deserved break. I'm joined by Danny Berger this morning. What we're looking at is equity market futures in the green this morning. Everyone has been talking about the fact that we are just treading water. What's the next catalyst? We're up. S&P 500 futures are up 0.3%. Bank of America has a new note out talking about investors are pulling money from U.S. equities and flocking into cash funds. That is something we caught up with Savita about earlier. She says we're not in a euphoric space right now when it comes to where equity markets are going. 2 hours away we are right now from the cash open. Let's look at some of these individual movers you need to know to start your day. Here's Yahira Anand. Hey, Yahira.
Hi, Annmarie. We start with the latest company to report results, and that is Under Armour. Shares are plunging down 13% after the athletic wear maker warned sales will drop far more than what was expected in the current quarter. This is a company that, like its rival Nike, was in the midst of a turnaround but is now hitting some roadblocks with those tariffs and a cautious consumer holding back any progress that it had made Next up, we have another company also falling, and that is Pinterest, down 12% here after earnings fell short of expectations. And it said that user growth in the US and Canada came in flat, a problem since North America is its most lucrative market. It did raise its full year outlook, but with the stock up 35% year to date before reporting, the bar was high and Pinterest just did not clear it. And we end on the real. Those shares are soaring 28% here. It's a big move on a small stock, but some interesting trends. The consignment company had a breakout second quarter, with the CEO saying that tariffs on luxury goods and rising prices at the likes of Chanel and Cartier are pushing shoppers toward pre-owned items. And it's a sign that even at the high end, consumers are looking for value. Annmarie?
Yeah, Hira, thanks so much. Yeah, they're saying that shoppers seek value, but if you've been into Real, it's still very expensive.
Sometimes it's more expensive than buying something new because, the whole fake scarcity of some of these handbags or not. But hey, good for the Real.
And also they have some vintage pieces where it's like if you don't get it here, can't get anywhere else. So you got to pay up. All right, on our radar this morning, President Trump choosing Council of Economic Advisors Chairman Stephen Miron to serve as Fed governor. Trump saying he will do a, quote, outstanding job as the search for a permanent replacement continues. So this is the question. Is he actually temporary, or could he move as a permanent replacement?
And that will make the difference for whether or not this market cares. Probably at the moment, not a huge reaction. I mean, a little bit of a dollar weakening, a little bit of a curve steepening, maybe some fears over independence. But overall, the board was already moving in a more dovish direction. So what difference would a Stephen Miron really make?
And he's already been Senate confirmed. So we know that even though he might not be Senate confirmed for September, he should be in the chair for October. Now, the Intel CEO is pushing back against President Trump's call for him to resign, saying he has the full backing of the company's board and has reached out to the White House to clear up, quote, misinformation, Danny, about his track record.
The thing about this is it's causing analysts to look at tech companies and all companies so differently. Bernstein had this note out. Unfortunately, unlike other tech CEOs, Libu does not appear to have cultivated the kind of personal relationship with Trump that would help assuage his ire. All of a sudden, we're trying to figure out, hey, who's friends with Trump? Is that going to be good for the company? Is it going to be helpful if you're Tim Cook to go and present a little plaque that is made of glass and gold to Trump to try to get on his side? The most absurd one of these, there was a Regeneron earnings call. They were part of the people who made COVID medicine, saying basically the president knows me by name and should like our company because we saved his life. That is a plus for them.
True. Currying favor of the president is a plus for a lot of companies, and that usually happens whether it's Republican or Democrat. More pressure potentially, though, for Intel CEO. Wall Street Journal says Intel directors have disagreed with him in his first months in the role about questions as central as whether the company should stay in the manufacturing business or exit it entirely. So actually for him, there might be some more pressure building up within the company. Sticking with President Trump, he's saying he'd be willing to meet with Russian President Vladimir Putin soon, even without Ukrainian President Volodymyr Zelensky present. Trump's still leaving the door open for possible penalties as well when it comes to Russia. I found this interesting yesterday because in the morning we saw the White House really push back on the Kremlin, saying there doesn't need to be a meeting with Zelensky and Putin in order for Trump and Putin to meet. And then Trump basically reversed that.
I think there's just this real question of what happens if Trump leaves empty-handed. What levers does the U.S. still have to pull? At the moment, it is clear that this is a White House that believes it is the economic lever that is the most important one. We've seen them pressuring India, upping tariffs to 50% for buying Russian oil. At the moment, India not really caving into that. If it's also a Russia that doesn't come to the table in any sort of meeting, where does the U.S. go from here?
And we're going to stick with trade right now, not just what's going on with India, but also what's going on with gold. And specifically, this really points to Switzerland. Gold futures in New York this morning surging to a record high after sources telling us at Bloomberg that Swiss gold bars are unexpectedly facing U.S. tariffs. Bloomberg's Oliver Crook joins us now. Oliver, what's going on? Are these tariffs going to stick?
Yeah, I mean, if the Swiss needed any more bad news, which I don't think they really did, they got it overnight, saying that basically, a part of the gold market that they thought was going to be exempted, which is sort of smaller Swiss gold bars that are about 100 ounces to 1 kilogram, those are actually now going to face tariffs. And you've seen the reaction within the markets at a time when we had the Swiss president going to Washington, D.C., failing to speak to basically anybody on the Trump trade team, only getting a meeting with Marco Rubio, coming back to Switzerland and having this emergency meeting with a bunch of businesses. We spoke to some of these sort of representatives of businesses to Switzerland. And I think that the takeaway is that they really are at this point at the mercy of the Trump administration. There was some discussions of how they could possibly retaliate, maybe canceling their orders for F-35s. They've got an order for 36 of those worth billions of dollars. But really they see that as only sort of worsening the situation. So again, in a week that you had really colossally bad news for the Swiss, they're stuck with that 39% tariff. And so you're going to see it in the gold market, obviously for watches. You guys were talking about luxury a little bit earlier, but also Nestle. Nestle's down 20% over the last month because all of the Nespresso capsules in the world are made in 3 plants, and they're all in Switzerland.
I thought you were about to say that Nespresso capsules are made with gold, and I was going to be shocked and go out and buy some. I'm glad that's not the case, Oliver. But to your point, Switzerland, considering retaliation, maybe they won't do it, as no other countries have. But what about a carrot, Oliver? What could Switzerland possibly offer this administration to get them to back down from the most severe of tariff rates?
Yeah, Danny, I mean, it might just be one of these sort of pay-to-play situations that you saw, out of Japan, that committing to that hundreds of billions of dollars worth of funding to basically go to Trump, what Trump says, whatever I want. Same thing that you got from the EU. That might be the route that they have to go. I think that basically what you saw is this is an administration, the Swiss, they thought they had a deal with Donald Trump. They thought they had it all locked and loaded. I'd spoken to the president a couple of months ago. She was feeling very good about that. And then suddenly that was not the case. I think he saw basically how big the deficit was, realizes how rich as a nation Switzerland is, and was really very unhappy about that in turn. So I think it's going to probably be, at some point, unless they find some other creative way, they tried to show up in Washington, D.C., it might be just a function of writing a check, which seems to solve many of the problems with the Trump administration.
Oliver, thanks so much for that. Bloomberg's Oliver Crook. And to that point, this is what our next guest has to say. We're joined by former Chief International Trade Counsel for the Senate Finance Committee, Bruce Hirsh, and he writes, our trading partners have had to adjust to the idea that these deals need to include offers to purchase specific U.S. goods or commit to invest in the United States. The bigger the number, the better. Bruce, thank you so much for joining us. This is exactly what Danny and Oliver were just getting at. The issue I have with this premise for Switzerland is that they are top 5 foreign direct investor already into the United States.
Well, they certainly are, and we have a close trading relationship with them, but we also have a trade deficit with them, and a large part of that deficit is on pharmaceuticals. And pharmaceuticals is one of the areas of great concern to President Trump. He wants to onshore that manufacturing. So he's going to look at that deal perhaps a little bit differently than he looks at some of the others. Also, he's really been counting on our trading partners to reduce their tariffs to close to zero, and that's difficult politically for a country like Switzerland to do on agricultural products.
So what do you think Switzerland can offer at this point, given the fact that Oliver just outlined how difficult these negotiations have become?
Well, I mean, there's the possibility that they'll make some very tough decisions on agricultural tariffs. Beyond that, if there have any other investments in the bank to put on the table here, that probably is going to be critical. I mean, I suspect that President Trump is looking for some sort of investments in domestic manufacturing here of pharmaceuticals, because that, again, is what he cares about. But it's hard to say, and they really are between a rock and a hard place.
Bruce, Annmarie's done really great reporting on this, that it did look like the Swiss and the U.S. had a deal before all of this unraveled. It's a less traditional type of negotiation that you need to satisfy the president himself rather than a coalition of stakeholders or the Senate itself. You've been in the room under more traditional trade frameworks. How does it change the negotiation when you're really trying to favor a party of one instead of more stakeholders?
Well, it's going to lead to a bit of confusion on both sides of the table because, I mean, as you mentioned, at one point, the question was, how do you satisfy Congress? They're the ones who have to approve the deal at the end of the day. The groundwork will have been done with Congress, with stakeholders to develop a U.S. position. Consultations will continue. You have a good sense of what you need to do. Now you're trying to satisfy a party of one. And because President Trump has a number of objectives and they can shift, whether it's revenue or industrial policy or leverage for trade or non-trade objectives, you just don't know. So both sides are at the table and they're trying to figure out what will satisfy President Trump, and they're not really quite sure.
Well, to that point, we're in this environment where it has been figure out the top line of the deal first and then the details later. Bruce, To what degree does that actually give the U.S. more leverage as things progress? The fact that we don't have these details, and it is something that Washington can push back on because you don't have the details in the fine print yet.
Well, it certainly gives the opportunity for leverage. It also gives the opportunity to disrupt the deals that you've just cut. We've already seen in some of the deals, both with the EU and Japan, they're concerned about when certain parts of the deal with regard to Section 232 national security sectoral tariffs, when they're going to be implemented. They were expecting them to be implemented right away. And that hasn't happened. So yes, it gives leverage, but the question is at what cost, and will it blow up the deal? So it's a great challenge. It also sort of undermines a lot of what these countries are looking for and what the markets are looking for, which is stability. Because to the extent that there are other things like that, there are these opportunities to disrupt the deals by continuing to push after the top line has been agreed to. That can undermine that sense of stability that everybody is seeking.
Modi is looking for stability right now. Bruce, what's going on with India and that trade negotiation?
Well, again, this really highlights the fact that the deals are made at the top. And, we had a situation in which the negotiators are right up to the cabinet level thought they had a deal with India. It was presented to President Trump, and he looked at it eventually and decided not enough. Again, a lot of countries are going to zero. India wasn't willing to go to zero on their agricultural goods. And so he just said no. And this is going to create a real challenge for a number of reasons. India's going to have to make some tough choices potentially. They may have to themselves cut a check of some sort. But politically, it's very difficult for Prime Minister Modi because he presents himself as a strong leader, and having to appear to cave to pressure is really going to be very difficult for him, either on these tariffs or on the relationship with Russia. So it's going to be a challenge on that one.
And he's even go out with the rhetoric saying this is going to be challenging, but I'm going to have to do it. He doesn't want to cave at this moment. We're going to be watching those trade negotiations very carefully. Former Chief International Trade Counsel for the Senate Finance Committee, Bruce Hirsh, thank you so much for joining us. Let's get you an update now on stories we're watching elsewhere. Here's Lizzie Burden with your Bloomberg Brief. Hey, Lizzie.
Hey, Annmarie. Bank of America's Michael Hartnett has issued some concerns that sweeping tariffs are crimping economic growth and leading investors to pull money from US equities and flock into cash funds. According to EPFR Global data, nearly $28 billion was redeemed from US stocks in the week through August 6th, while money market funds attracted about $107 billion, the biggest inflows since January. Elsewhere, Firefly shares climbing after its initial public debut. The shares closing at over $60 per share on Thursday versus the initial price of $45 each. This marking the next evolution for a company that survived bankruptcy to develop its own rocket fleet and successfully land a private spacecraft on the moon. And Tesla is disbanding its Dojo supercomputer team. The Dojo system that was used to train the machine learning models behind the electric vehicle maker's autopilot and full self-driving programs, as well as its Optimus humanoid robot. Peter Bannon, who was heading up Dojo, is leaving, and Chief Executive Officer Elon Musk has ordered the effort to be shut down. And that's your Bloomberg Brief. Annmarie.
Thanks so much, Lizzie. Up next on the program, betting on the Fed.
President Trump keeps talking about that we're the hottest country ever. Look, I agree with him. But what he seems to be implying is we're the best credit rating, so we should have the lowest interest rates. That's not how you set sovereign yields.
For more on that conversation, Kelly Kowalski of MassMutual coming up next on the program. You're watching Bloomberg Surveillance. Good morning. Good Friday morning. I'm Annmarie Hordern alongside Danny Berger this morning. If you're looking for any concern or uncertainty in the markets this morning, it's not going to be in the equity market. It's not even going to be in the bond market. Look at what's going on in gold futures in New York, up nearly 0.7%. If you woke up this morning, you're now realizing from the U.S. Customs and Border Protection, they are clarifying that 1 kilogram and 100-ounce gold bars are now subject to reciprocal tariffs enacted by the president. Danny, gold bars were supposed to be exempt.
It is another case where we have been surprised by some change in the tariff policy. Last week, it was copper. All of a sudden, they got exempt, and it caused a crash in this market. At the time, I had spoken to Julian Emanuel of Evercore, who said it is evidence that this is a market that is unprepared, that some of these tariff moves can cause VAR shocks that spill into other assets. We're not seeing that with gold at the moment, but still his point stands. Are we complacent? Are we ready for a fast-changing trade narrative?
Right. Could there be more surprises coming down the pipeline, especially since you said earlier we have these shock and awe, big top-line deals, but then when you work into the details, actually things might get a little bit more confusing and complicated. Sticking what's going on in Washington and policy uncertainty under surveillance this morning, betting on the new Fed.
President Trump keeps talking about that we're the hottest country ever. Look, I agree with him. But what he seems to be implying is we're the best credit rating, so we should have the lowest interest rates. That's not how you set sovereign yields. That's how you price a mortgage on Trump Tower in Manhattan. The way you set sovereign yields is the combination of growth, inflation expectations, and supply should determine kind of a natural or neutral interest rate.
Here's the latest. Traders holding on their bets for a September rate cut as President Donald Trump makes his mark on the Federal Reserve. Kelly Kowalski of MassMutual writing, quote, "It is likely that the Fed will cut in September. Inflation still puts the Fed in an uncomfortable position to be cutting interest rates and could limit the number of cuts into year end." Kelly, thank you so much for joining us. Right now, we've seen the market really start to expect a September cut after that weaker than expected jobs print and the revisions. But what if we get two CPI prints that are hot before September?
That's a great question, Annmarie. Thanks for having me. I think as we look at what Chair Powell said in June, he characterized the labor market as solid, and we know that's no longer the case. I think it's going to take a very high bar and probably very significant readings in inflation for us to really see that 90% probability of a cut in September come down. But at the same time, you hear a tone from the Fed that they think that this pickup in inflation is going to be temporary, dare I use the word transitory. So I think as long as we, sort of continue to see that prioritization of the labor market and that tone of sort of looking through inflation, that we will see that cut in September.
Given the fact that the market is already pricing in the September cut, does it matter if Trump's new pick, Steve Myron, is there or not?
Yeah, I'm not sure how much he really moves the needle. We knew it was somebody that's going to be more on the dovish side. He certainly has some rather unconventional and radical views on policy. But I think the markets are more going to be focused on ultimately, who the chair will be.
In terms of what we've heard from Fed officials at this moment, Kelly, over the past week, the ones who've turned more dovish, it seems like those among Daly, even Kashkari, are talking more about adjustment, getting somewhere closer to neutral, not downright accommodative. What does that mean in terms of just how much risk can rally off the back of more Fed cuts?
Yeah, well, when I look at sort of where we are in terms of, call it the real Fed funds rate, we are around the same levels where we were at the end of 2024 when we were adding, 200,000, 300,000 jobs. So there is some validity to, we are a bit restrictive now given the economic environment. I think the market is looking to these cuts as somewhat of a cushion, but at the bottom line, it's really coming down to the fundamentals, the corporate earnings. And it appears that, we're in credit markets. We're certainly seeing credit markets focus more on, the underlying company fundamentals and the technical picture as well.
Well, to that point, just looking at the flows in Bank of America's latest report, looking at EPFR data, they noted that you are starting to see a back out or at least a slowing down of flows into U.S. equities. There was an outflow there over the past week. But it is credit that continues to look so strong, Kelly. The stat they have is that IG and high-yield bond funds drew the most since June of 2020. What do you make of that continued demand, even if some of the other risk assets start to slow?
It is certainly not an easy position as a credit portfolio manager right now. We look at credit spreads, which are, a perceived measure of credit risk in the market. And those are at the same level in investment grade and high yield markets where they effectively started the year. So if you look at all the changes we had and you say we're at the same level, that's very surprising to anyone. It's really the technical trends that is driving that. You have a lot of yield demand. We call it yield buyers, particularly in the long end, and a lot of the issuance around sort of the post-COVID time where borrowers issued shorter. That's all coming due, so it all needs to be reinvested. And the question is, when are we ever going to see sort of that strong technical demand decline? And so far we haven't, even with the IG credit index falling below 5%. We had deals this past Monday that were 5 times oversubscribed.
So if some of the credit demand we're seeing and the spreads being really tight is for a technical reason, Kelly, what does that mean about the credit market's ability to be the canary in the coal mine? You've seen that in past crises or past moments of stress where first it's credit spreads that widen and that goes into the stock market. Will that not be the case this time because of this almost mechanical tightening of spreads?
Yeah, I think that's a great point. And there's definitely some distortion there because of those yield buyer components. If you do look, however, in for example, the CCC market, which is the weakest part of high yield, those spreads are, at the wides, much wider than where they were earlier this year. So you are sort of seeing that risk priced in, but that's in the much lower rated parts of the market. And we continue to see just, really strong demand for investment grade and sort of the higher quality pieces of credit.
What about some of those sectors that are dealing with the on and off concern of what's going on with tariffs?
Yeah, so we are really being intentional about which sectors we're involved in, especially in this environment, especially when you think about our sort of direct lending portfolio, for example, of, smaller companies, really staying away from consumer, anything that really has a more cyclical component. So it's certainly a time when you want to really think about your sector exposure and the total macro environment.
Kelly, thanks so much for your time this morning. Kelly Kowalski of MassMutual. Danny, what's so difficult about this moment right now? A ton of headlines going on, but you have to say, really, to Kelly's point, sector specific. Because also, what we are still waiting on from this White House is sector specific tariffs on top of those reciprocal rates.
I'd say one of the remarkable things, though, is since the nadir of this market in April, every single sector is higher except for healthcare. And I think it is those sectoral tariff concerns, but even things pharmaceuticals, exactly. But even things like consumer discretionary, I think they're higher by more than 24% since the bottom. And this is a sector that there are real fears of, will there be price increases that pressures the consumer? Can they hold on to their margins? Still, it's higher since the bottom.
That's a question, and we'll be focusing on that as well. Coming up in the next hour, another hour of Bloomberg Surveillance, Julie Biel of Kayne Anderson Rudnick, John Vinh of Keybanc Capital Markets, Kathy Bostjancic of Nationwide, and Collin Martin of Charles Schwab. You're watching Bloomberg Surveillance. You don't want to miss another hour. Danny and I will be back. Good morning.
There's still a ton of uncertainty within the market to come.
The market just keeps moving sort of relentlessly higher.
Stay long the S&P. It's almost impossible to beat.
There's incredible dynamism. Investors want exposure to that around the world.
For the US to outperform from here, you essentially need to argue that we're going off, into the unknown.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning from New York City. For our audience worldwide, I'm Annmarie Hordern. This is Bloomberg Surveillance. Danny Berger joins me today. John and Lisa are off. As we look to close out the week, the market is pricing in a September rate cut, and the president, of course, now getting his first opportunity to put his stamp on the Fed this term. And we have Kugler stepping down today. Steve Myron, says, is going to take that seat. Of course, there's questions about whether or not how quickly you can get him into the seat, but it might not matter given the market is already pricing in a September cut. next week will be key. Whether or not the market will continue to price in a September cut, Danny, because next week we get U.S. inflation data.
And it will be one of only 2 inflation data prints that we're going to be getting before the next Fed decision. Hence why all of this data in the run-up to it is so important. There was this narrative, though, that evolved last week after the really poor jobs data. This question that came up, is the employment trend worrying enough that this is a committee who can go ahead and cut regardless of what CPI is? But if we get prints like we had from ISMs earlier, then it's an issue. ISM services data really weak, but prices paid the highest since October of 2022. Does the data show that maybe there's a stagflationary bend to where this economy is headed?
Potentially, and the ISM data definitely is showing that, and that is why CPI next week is going to be really important. There's one more jobs print, 2 CPI reports before we get the next Fed meeting. Futures this morning, just once again shy from an all-time high as they start to digest a lot of what's going on. There's another big story to focus on today. Not everything is just about the data and what's going on with the palace intrigue and the Fed. Trade stories, the shock and awe from the White House. Then you look into the details. Then you have the customs and bureau statistics come out and say, actually, this is where the tariffs are placed now. Gold futures. There was supposed to be an exemption on gold bars coming into the United States, Danny. And now, actually, you have to pay that higher rate. And a lot of these gold bars come from Switzerland.
Yeah, this gold market's been through a lot from the start of this year of everyone loading up planes with gold bars, trying to get it over to the U.S. because there had been a premium. Now, reporting from our team suggests that Asian refiners of gold aren't even shipping gold to the U.S. anymore because there is so much confusion. It's gold bars today. Last month, it was copper getting an exemption that caused the market to crash. It shows that there are differences in terms of how we interpret the trade negotiations and the different tariff rates that do cause fissures in this market.
And I think it's important as an investor. You have to take the cue from the president when it comes to Truth Social, but then to really understand the details, what's going on with trade, you have to look up what the Customs and Border Protection is actually putting out, because they're the ones that are changing the computers at the border.
And that's part of the confusion. For example, there was this whole brouhaha over Japan and if tariffs would be stacked and just how much they were paying. Well, the Japanese has come out and said, oh, the U.S. told us it was a mistake and they're going to rectify it. I'm not sure we totally heard from the U.S. side whether or not it's a mistake. So different parties are saying different things. Who do you trust? Where do you go to try to navigate headwinds from here?
And until it's changed, you're paying those tariffs. Coming up in the program, Julie Biel of Kayne Anderson Rudnick with stocks sitting near record highs. John Vinh of Keybanc Capital Markets as Intel defends its CEO to the White House. And Kathy Bostjancic of Nationwide on why the Fed could cut 75 basis points this year. And we begin this hour with stocks holding near record highs. Julie Biel of Kayne Anderson Rudnick writing, I'm really struck by how companies are figuring out how to manage not just with tariffs, but also with the uncertainty that more can come. Julie joins us now. Julie, a lot of investors said the tariff story is behind us. We had the lows of April. The market has rallied some 30% since those lows. And then we talked to someone like Lori Calvasina, who goes through all the earnings report, and she says, I still see a lot of angst. How much angst is out there when it comes to this trade story?
I think there's still a lot of angst. I think most of the angst is really targeted towards we don't really know what to do about it. We don't know what the actual rules and parameters are going to be. And we also know that even once we do know that it can change really quickly. That's where I'm seeing the most angst. But what I am also seeing is a lot of companies just trying to figure out and scotch tape together some kind of supply chain plan in the interim that is allowing them to still meet the still strong consumer demand. So I think overall the underlying businesses are good. I think CFOs are trying to be a little bit thoughtful and a little bit careful in terms of giving themselves some breathing room so that if tariffs do become more of a problem, that they're not going to get dinged for it as hard as if they have problems within their core fundamental business.
What parts of the market and industries are really digesting this churn the best?
I think that, in most of the places where you're talking about services, you're seeing companies having no problem really because they're not as impacted by tariffs. They are in some cases. And I think there is still some concern that the U.S. is an exporter of its services. And so there's some fear that there will be something reciprocal that could happen. You can hear that in a lot of the earnings calls. There's a certain caginess about that. I think that in general, manufacturing has been a place that has been so negatively impacted. And the thing is, it was already weak to begin with. And so those are the companies that really are uncertain how to incorporate tariffs. Do they let the margins drift downwards, or do they try to take more pricing? For the time being, we're lucky that we're in a time period where margins are at record highs for most companies. And so they seem to be willing to digest and eat it for the time being. But I think if tariffs accelerate from here or increase materially in their cost structure, then I think more pricing is going to happen.
Julie, it's not just that CEOs have to contend with. The rhetoric has stepped up, or at least continued, of this White House being very willing to call out CEOs. Yesterday, it was the Intel CEO. The day before, it was Bank of America and JP Morgan. Earlier in the year, it was Walmart. How does that twist introduce the differences of how CEOs should be reacting, especially when you think about their commentary on earnings calls? Does that mean that we're seeing more reserved CEOs, more careful CEOs, knowing that they could have an audience in the White House?
Absolutely. I think, and that is a strange effect that we're kind of in uncharted waters, at least for modern times, to have this level of scrutiny, right? And it wasn't just like most recently, right? Remember when Amazon was talking about including their tariffs and then getting absolutely browbeaten? Most companies are taking as low a profile as they can. They're trying to talk about tariffs in a way that is not critical, even though I think many of them can recognize that it's created a whole lot of friction in the system and increased costs for them. I think the big challenge for them is that they have to start being able to incorporate it and recognize that it's going to either be problematic for their business in terms of hitting their earnings, or you're going to see more pricing pressure. And that's actually a pretty tricky place to be in for many CEOs. I think most of them are just doing everything they can to keep a very low profile, to talk about tariffs as it's something that's not necessarily a bad thing. And I think that that's weird, right? Because in our discussions with management teams, when we sit down with them, many of them are sort of rolling their eyes and saying, it's just really hard to manage from here.
How much of it is also a reticence to discuss it, Julie, because of the absolute punishment of companies this quarter who talk about tariffs? You can have AMD, for example, have really good earnings, but then flag that they don't know what's happening with China and their stock craters. How much of it is because they see some of those executives expressing that uncertainty or doubt and their stock gets punished for it?
You are not getting paid for transparency. That is for sure, right? Like, so I think that they're trying to thread this needle of being forgiven if tariffs end up being a bigger problem for them in their guidance and they miss it. So they're trying to create space for themselves, but at the same time, keep as low a profile as possible and try to stay out of the lens of Trump. I think it's really important for many of them to just not be visible in any way, shape, or form. And you're right, it's not even just Trump, it's really all of it. They really know that the market is being very sensitive to who are going to be the winners and who are going to be the losers. And I think that that's kind of the challenge for many of them.
As we are in the middle of earnings season, Julie, I know you put out in this note, is small caps ever going to perform? Are they? Who do you like?
I think that the good thing about small caps is, one, they're cheap. And two, they've had almost 2 years of weaker earnings as a result of tariffs and not being able to have the same pricing power as large cap. But within small cap, we are seeing businesses that have actually been resilient, that have matched the kind of growth curves of large cap. And most of them are faster growers than large cap, right? If I take out the Mag 7 from S&P earnings for the rest of the year, we're kind of looking at low to mid single digit growth for large cap, the S&P 493 or whatever it is we're calling it. Small cap is easier comps and it's much cheaper. So name that I really like is Simpson. That's a company that's really been able to figure out how to work through tariffs. Lemaitre is in healthcare. What I'm looking for are companies that are not going to be negatively impacted by AI, that are doing real analog things that can't be replaced, but also are companies that have that resilience in their earnings. So it's strange, but industrials and healthcare are kind of places where I'm seeing more opportunity and the valuations are pretty compelling.
So it sounds like at some point you think they can perform well. Julie Biel, thank you so much for your time this morning. That's Julie Biel of Kayne Anderson Rudnick. Let's get you an update now on other stories we're watching elsewhere. Here's your Bloomberg Brief with Lizzie Burden. Hey, Lizzie, good morning.
Hey, Annmarie. Good morning. Under Armour shares are plunging in the pre-market. The sports retailer forecast worse than expected sales for the current quarter, with revenue expected to fall between 6% and 7%, more than double what analysts were projecting. The results underscore that the turnaround efforts Under Armour is undergoing are showing signs of stalling. Elsewhere, Meta has picked PIMCO and Blue Owl to lead a $29 billion financing for its data center expansion in rural Louisiana. Sources telling us here at Bloomberg that PIMCO is expecting to lead a $26 billion debt portion of the financing, while Blue Owl is providing $3 billion of equity. Representatives for Meta, PIMCO and Blue Owl declined to comment. And OpenAI is rolling out a new AI model called GPT-5, which is designed to be more capable at coding and creative writing, as well as reasoning through complex queries. CEO Sam Altman called the new model a major upgrade, saying it really feels like talking to an expert in any topic. It'll be made widely available to all free users. And that should be my brief. Annmarie.
Thank you so much, Lizzie, for that slightly concerning news. Up next this morning, calls from John Viff of Keybanc Capital Markets as tensions soar between Intel and the White House. That's next. You're watching Bloomberg Surveillance.
Investors have wrapped their heads around the idea that tariffs are here to stay. I think it's also a question at this point in time, how does that filter through, not just with the rates themselves, not just with inflation, but also with demand. Companies have been talking a lot about mitigation. Some of them have alluded to the idea that they're still figuring out some of those plans. So, I think we had a big shock back in the second quarter. Corporates reacted, and they're kind of coming back down to earth and digesting still.
Tariffs are here to stay, as Lori Calvasina told us earlier for RBC Capital Markets. And you can see that today when you look cross-asset on what is going on in financial markets. Yes, S&P 500 futures up nearly 0.3%, but it's New York gold where all the action is, up 0.7%. And this comes after everyone initially thought gold bars coming to the United States would have this exemption, especially when it comes to with Switzerland. And then the Customs and Border Protection actually clarified that they are going to be subject to that reciprocal tariff rate.
And I think it's notable that it's coming from Customs. They're the ones saying this. This is coming as a surprise because it's not something we heard from the president, from the Swiss, from anywhere else. It just underscores the confusion when you have these deals that are reached, that are just the top line first, details later. These things can pop up to the point where there were analysts who spoke to Bloomberg saying, we're not sure if this is just a mistake from the Customs Border Patrol and something that will be reversed.
Potentially, we are going to get more information about this, maybe a clarification from the White House on whether or not these tariffs are on or off. And it also comes at a time when Switzerland is still trying to get a deal with this White House.
Yeah, to your point, you've done such good reporting on this that the Swiss did seem to have a deal before we had the day that tariffs were announced. But even if you have a deal, Annmarie, it doesn't necessarily mean that things are smooth sailing. We learned that from Japan, which overnight was complaining that it looks like tariff rates are being stacked. It's hitting those auto manufacturers really hard. Japan has said that the U.S. is walking that back, but are they really? How long does it take to rectify, and will there be reimbursements for those who have suffered?
As Lori said, still a lot of angst right now when it comes to tariff policy. Time now for the morning calls. First up this morning, Morgan Stanley cutting its price target on Eli Lilly to $1,028, citing a lower bull case for the company's weight loss pill, though the stock is up more than 1% today. Next up, Wells Fargo raising its price target on Instacart to $55. Instacart this morning up nearly 10%. They're citing healthy margins despite a drop in average order values. And finally, Melius raising its price target on Apple to $260, pointing to new products and increased value in iPhones. We want to stick with tech right now. Intel CEO saying he has the full support of the board, with President Trump calling for his resignation. Mandeep Singh of Bloomberg Intelligence joins us now. That's what they're saying out loud. Wall Street Journal, though, has a report that actually he has been under pressure from the board as well when it comes to how the direction of travel should go when it comes to Intel. Do you think he can keep his seat?
Well, right now, it's clear that there is a disagreement between the board and his strategy. He wants to keep the foundry business. The chairman of the board feels they should be divesting the foundry business. And look, I think the Walden International connection, where Walden is a VC firm in China that has investments in almost 70 companies, some of them are on the entity list. It kind of begs the question, how did he take the top job at Intel, given he was still the chairman of Walden International? And it's not just, one or two investments. I mean, they are pretty big in China. So from that perspective, I do think there will be pressure in terms of explaining, exactly what the board knew and, why they went with him, et cetera. But turnarounds are tough. In this case, Intel didn't have a choice. They tried almost, a decade to fix their manufacturing. They had 3 or 4 CEO changes. So a lot happened in between, and clearly there are still no signs of turnaround. And so from that perspective, there aren't a lot of choices for Intel to have a new CEO who can really come up with a turnaround strategy.
I say Lip-Butan's only been there since March. Just how much of a setback would it be if this is a company that decides they need to hunt for a new CEO?
I mean, big one, because he clearly has the credentials, both on the VC side as somebody who has invested in startups, as well as he's deeply technical with semiconductor experience. So he really was the right person for the job, and it's too early to judge his strategy. He's focused more on cost controls right now. But I think something like this kind of makes it hard for him to pursue a foundry turnaround. And to me, foundry is critical to Intel. If you divest foundry, then the company will be broken up, and it just doesn't have the same kind of cachet that it has had over the last 4 decades. So foundry is integral to Intel.
Mandeep, thanks so much. Mandeep Singh, of course, of Bloomberg Intelligence, joining us this morning. And we want to stick with Intel. John Vinh of Keybanc has a sector-weight rating on Intel's shares. John joins us now. John, Mandeep was really outlining here that it's not just the President of the United States. He might be the final nail in the coffin, but actually there is the board that's pushing back on the CEO's strategy right now when it comes to Intel. Do you think he can stay in the top position?
I think he can. Right. I think if you kind of take a step back, there's only a handful of executives out there that are capable of leading Intel. And clearly, during the search, he was their top pick. Right. He was on the board of Intel, is deeply familiar with the challenges that they had. He's had a lot of success historically. He's been successfully run Cadence. So I think I think there's a lot of noise going on right now, but taking a step back, he's the right person to kind of run Intel at this point.
He's the right person, John, but what happens if it's a White House that is unsatisfied if he stays on as CEO? Just how painful could they make things for Intel?
Yeah, I think he's got to learn to kind of manage up, if you will, to the White House. Obviously, this is a uncharted territory for public company CEOs if you are singled out by the President of the United States. But yes, this would be extremely difficult if he doesn't figure out how to kind of manage up to the White House. A big beneficiary that Intel is of the CHIPS Act, right? They're going to get a significant amount of funding from the U.S. government to support their manufacturing initiatives. And if he's not willing to play nice and manage up, a lot of that funding could be at risk.
Well, he wrote a note, made it public as well, basically saying that they're trying to work with the White House to alleviate any concerns. John, what would it look like to manage up? How would Intel get out of the situation in the ire of the president that they have right now?
Yeah, I think at this point, I think the tension between the administration and Lip-Bu right now is how much they're willing to commit to manufacturing in the U.S. I think if you look at Lip-Bu's predecessor, Pat, he kind of maybe was a little bit too aggressive in terms of building out capacity to manufacture in the U.S. He was of the mindset of, if we build out this capacity, they will come. Lip-Bu, as we've seen, has taken a much more disciplined approach at spending. He's come out and he said, we are very excited about our next process node, 14A, but we are going to be much more disciplined about it, right? If 14A doesn't pan out as we'd like, I'm not ready at this point to fully commit to 14A, which is leading edge manufacturing in the U.S. So I think he's got to carefully choose his words and communicate to the White House that he's fully committed to U.S. manufacturing, but he's got to be very careful about committing the full amount there, and just be very careful about how he selects his words.
John, how can he be explicit to the President of the United States when the Wall Street Journal this morning is saying that he and some Intel directors have disagreed about simple questions as whether or not the company should stay in the manufacturing business or exit entirely. Doesn't he need to shore up his own company, the directors, the board, before he starts making matter-of-fact statements to the President of the United States?
Yes, I do agree that he's got to kind of figure out also how to manage the board, but it's not a surprise that they are having differences, but I think this is why they needed to bring him in. You know, Pat, the previous CEO, had the full support of the board, and obviously that strategy wasn't working. So they had to bring somebody in to kind of change up the strategy, and I think that's what the board and Lip-Bu are going through right now. They're going through some of those growing pains.
John, I would love to get your read on the wider chip sector now that we've had some of the earnings under our belt. It was an AMD that was punished for voicing uncertainty when it comes to whether or not they'll be able to sell some of their key technology in China. You had the likes of NXP, for example, saying they were uncertain of how much of a pull forward they had in terms of orders. Just how much clarity do you have on the sector as a whole for where we move from here with some of these tensions still very front and center?
Yeah, there are clearly a lot of cross currents right now. I think the trend that we are seeing, last night we had market chip, which was a great print. Stock's down 8% pre-market today. I think what we're seeing right now is it doesn't matter how good your print is and how good your results and guidance is. Everything's getting sold in this market. I think people are very nervous that a lot of the strong results that we're getting in this environment is a function of pull forward demand related to tariffs. I think there's a lot of concerns that this could result in a weaker second half. There's a lot of concerns that this could undermine kind of the cyclical recovery that we're seeing in the broader chip sector. And then on top of that, right, you've got these geopolitical uncertainty that is layering on top of that, right? Just the other day, just in the middle of the earnings period, you know, you had the Trump administration levy a 100% chip tariff on companies that aren't willing to commit to building in the U.S.
Right, and then potentially export controls. And do they actually mean that they're going to be licenses that are going to be taken back, or will they just be U-turned like we saw with the H20? John, thank you so much for your time this morning. John Vinh of Keybanc Capital Markets. Danny, when it comes to Intel, just quickly, I think the CEO needs to make sure he has the board behind him before he starts going to the president. The Wall Street Journal story really outlined that at the moment there's a lot of disagreements there.
Yeah, and to Mandeep's point, there were those connections very apparent that he had with China, yet it's a board that approved him as CEO. Are they going to have to rethink things? Can he survive? John certainly expected him to survive because he had the skill to do so.
Well, we'll see what he says to the president. Maybe there's an Oval Office meeting. Coming up next, Kathy Bostjancic of Nationwide expecting a 25 basis points of Fed rate cuts this year. Plus, Yahaira is back with your morning movers. Keeping an eye on Under Armour this morning. That stock under pressure, more than 15%. You're watching Bloomberg Surveillance. Good morning. Welcome to Bloomberg Surveillance. I'm Annmarie Hordern alongside Danny Berger, John and Lisa on some well-deserved time off. This morning, what we're seeing in financial markets, S&P 500 futures up 0.2%, looking to close out the week in the green, just shy of record highs. If you're looking for any sort of confusion when it comes to Washington's trade policy, today it's in the gold market. These are gold futures in the United States, up more than 1%. What analysts and traders are saying is they are all trying to scramble to understand what is happening between what they thought was meant by tariff policy out of the White House when it comes to gold imports, especially from Switzerland, which is facing a 39% tariff rate, versus what the Customs and Border Protection put out. And they have clarified that 1 kilogram and 100-ounce gold bars are subject to reciprocal tariff rates enacted by Trump. Tons of confusion, Danny, and you've been really good on signaling that this is just potentially one of the fallouts of as we try to get more details of the trade policy.
It keeps happening in different fronts, be it gold, be it Japan, be it copper last month, but it's kind of the worst time for gold because there is a lot of demand there right now. The uncertainty means that gold as an asset class, especially as the dollar's lost its favor, has looked more favorable. The problem is that in the U.S., you have these brokers who need the physical gold to back what people are buying. What happens if you can't get that? Does it mean Annmarie and I need to go on a plane, bring our suitcases to Switzerland, and load up on gold ourselves.
Or Hong Kong. Maybe that's where John and Lisa are. They're getting that arbitrage right now. They're buying at these very low discount rates, putting it in their suitcase.
Good for them. I hope they are.
Me too. I mean, they're going to be making quite a lot of money. All right, we're 1 hour away from the cash open. Let's get your morning movers with Yahira. Hey, Yahira.
Hi, Annmarie. I mentioned Under Armour earlier, but worth noting again, since the stock is plunging even further, down 17% now. This is after the athletic wear maker warned that sales will drop far more than expected in the current quarter. And this is a company that, like its rival Nike, was in the midst of a turnaround, but now it's hitting some roadblocks with tariffs squeezing its bottom line and cautious consumers not buying their apparel. Next up, we have shares of Goodyear. They are also falling down 11% now after reporting a surprise loss when analysts were expecting a small profit because it was thought that this is a company that could benefit from tariffs since it is a domestic tire producer. But the CEO called the quarter challenging on both the consumer and the commercial side of the business, specifically saying that that was due to shifts in global trade. And we end on Expedia with all this talk about travel. You've been saying the shares are up 15% after the travel company raised its full year outlook as they see a recovery in demand, specifically in the U.S. The CEO saying that since the beginning of July, they have seen a pickup in travel demand, especially in the U.S., which had lagged. But with all the chaos of April and May, I hope everyone is taking a vacation.
Yeah, everyone needs a little bit of holiday. That's what John and Lisa are doing. And I'll be doing that hopefully at some point in the next month. Let's turn back to the Fed now. President Donald Trump tapping Council of Economic Advisors Chairman Stephen Miron to serve as a temporary Federal Reserve governor through January 2026 as Fed Governor Christopher Waller emerges as a favorite for Fed chair among the Trump team. Bloomberg's Michael McKee joins us now. Mike, first let's start what's going on with Steve Miron. This is an individual that's close to the president, and he's now going to be moving from the White House to the Fed. Does it change anything?
Really doesn't change anything because, of course, as we've said many times, the Fed is a committee of 19 people, the Open Market Committee, and 12 of them vote. So one vote isn't going to change a whole lot, and he's not being nominated for chair, so it's not like he's going to have a huge amount of influence on what other people think. But he probably is going to be able to help the president sell his idea that we need to cut interest rates. The Fed seems to be leaning in that direction, but not the 300 basis points that the president wants. So maybe he'll go deeper on that.
If this is a White House, Mike, that does decide to put Waller up for the chair of the Fed, how much would a Waller chairmanship differ from that of a Powell's?
It probably wouldn't differ a whole lot in that Waller's an institutionalist. He's been at the Fed since 2009, starting at the St. Louis Fed. He was an economics professor before that. And so he believes in the institution. And he would probably he would tell you that he's a pragmatic person rather than a dove or a hawk. He came to the Fed when he joined the Board of Governors as something of a hawk, wanting the Fed to raise rates when inflation was rising. Now he's the dove, but he could change again if we start to see inflation rise a lot on the back of the tariffs that are starting to be implemented.
Mike, the next Fed meeting, and I know, of course, the press conference you'll be at, that one is going to be fascinating as we track this musical chairs. Michael McKee, thank you for your time this morning. We're going to stick with the Fed. Kathy Bostjancic of Nationwide writes, quote, we maintain our forecast for a total of 75 basis points of rate cuts by year end. The inflation impact from tariffs will be a temporary adjustment that will fade over time. Kathy, thanks so much for joining us. Let's just quickly talk about the cuts you have baked in. Does the musical chairs that Mike just outlined change any of that?
Good morning, Annmarie. Happy to be with you. I don't think it does. I think, Mike's point was well taken that the data is already getting the Fed to start to lean towards rate cuts sooner rather than later. So I really think the data is going to play the primary role here. I think changing, having Stephen Miron join obviously gives a more robust support to cutting rates sooner rather than later. But as Mike pointed out, it's a committee. He alone won't sway things. And I think Fed Governor Waller, if indeed he becomes the new Fed chair, now that will be next year, I think I would agree he's just going to continue to be really pragmatic, but looking at the data, driven by data, not politics.
When you're looking at the data, definitely predicated on what's going on in the labor market, is giving individuals room to start to come out and talk about the fact that they think, individuals at the FOMC like Lisa Cook, that they think that potentially they have to start cutting, joining the dissenters. But Kathy, what happens if we get a hot CPI print next week?
It's a risk, and it can certainly complicate things for the Fed as they do their analysis. I think that at the end of the day, they're going to put more emphasis, if indeed the labor market is slowing in a material way, and the economy continues to have kind of sluggish performance in the second half of the year. I think they'll turn their attention and put more emphasis there than on inflation, even if we get a surprise uptick, because that should largely be temporary, especially if it's driven by tariffs and goods prices that are being increased by tariffs. And keep in mind, we're also getting some disinflation from the service side. So, they can look at inflation as a whole and say, okay, maybe things are not, inflation's not getting out of control. Inflation expectations are spiraling higher.
So are we already there, Kathy, where the level of some of the weakness in the labor market is enough to look through inflation? And if we're not at that level, what do you need to see in the next jobs print to allow this FOMC to look through some of the inflation figures?
Yeah, it's a great question. I think we're there, but of course we'll get another month's worth of employment readings and readings on the economy for the Fed to digest. But I think when you saw the July print, which was on the softer side, and then there's downward revisions prior months, really suggests that, and we look at the data, private sector job growth has just stalled. And while there are not large layoffs, if you do lose a job, the continuing claims told us yesterday, it's really hard to find a new one, and new entrants are having a hard time, college graduates, young people. So I think we are seeing the cracks in the labor market widen, and I think that is, and keep in mind, employment's a coincident indicator. So if you wait until it really cracks, you're behind the curve.
Kathy, is the information that we've received about this labor market, is it enough to maybe rethink the Fed's terminal rate? Does it lower it? Are we maybe more restrictive than we realized?
So I think, so good point. I mean, Fed Chairman Powell has said we're slightly restrictive. Waller makes the case we're very restrictive right now, right? Saying the long run neutral rate is 3%, and you've got a Fed funds rate between 4.25% and 4.5%. About a few months ago, we had a call for the Fed to cut rates 50 basis points in September. We backed off of that, and now we have 25 basis points because we thought Fed officials were too cautious to go 50. I think the case for 50 is building. I'm not saying they would actually would do that, but that's a possibility. But I think by year end, certainly they could go 75 basis points. That'd be 25 per meeting, and then they'll have to see how the economy unfolds next year to see whether they need to cut rates further.
One of the other elements to this, Kathy, is while it's a labor market slowing, while there's less demand to add on new workers, all of this demand is emerging in AI and the big tech spending. Are you a believer in this narrative of crowding out, that all of the investment needed from tech, all of the utilities, and all of the energy that they're hoovering up is crowding out the rest of the private sector?
Mm-hmm. It's an interesting way of looking at it. I mean, we have thought it's been the uncertainty over tariffs and trade policy that was suppressing other capital expenditures. So where we did see strength, as you noted, was AI and the high-tech spending. And I think that's because companies feel that's where the greatest return on investment is, right? And given all the other uncertainty on structures, building out structures, new plants and equipment, they were more cautious. We were thinking that once we get past this peak uncertainty, which I think we're past, but uncertainty diminishes more, they can start to loosen up on spending rates, especially go into next year. So I guess we'll have to see whether there is a crowding out effect. I'm not really convinced of that. I think companies have cash and cash reserves and the ability to invest. They've just been holding off for now.
Kathy, thanks so much for your time this morning. Kathy Bostjancic of Nationwide Insurance. And we want to get you an update now on stories we're watching elsewhere. Lizzie Burden is back with your Bloomberg Brief. Hey, Lizzie.
Hey, Annmarie. President Donald Trump says he'd be willing to meet with Russia's Vladimir Putin soon, even if Putin hasn't agreed to sit down with Ukrainian President Volodymyr Zelensky. According to the Kremlin, the US and Russia have agreed on a venue for the meeting between the two leaders that has not yet been disclosed to the public. And President Donald Trump tapped Council of Economic Advisers Chairman Stephen Myron to serve as a temporary Fed governor through January 2026. Trump will continue to look for a permanent replacement in the interim, with the race for Fed chair still underway. Sources telling us here at Bloomberg that Fed Governor Chris Waller has emerged as a top candidate for the role among Trump advisers. And the US Customs and Border Protection Agency has clarified that gold bars are subject to tariffs, according to people familiar. Gold futures surged to a record high in New York as traders are scrambling to understand whether the tariffs are already in force, if they apply to all countries, or how they might be avoided. And that's your Bloomberg Brief. Annmarie.
Thanks so much, Lizzie. You see the arbitrage right there on that screen. If you were in Hong Kong or London, you can basically get gold and somehow get it to the United States and maybe sell it.
Yeah, that was why earlier this year planes were literally loaded up. I think they were literally like stripping out seats and putting gold in instead. I guess the time for that is over now, because if you're doing that from Switzerland, 39% tariff, at least for this moment.
And the big question is whether or not this actually sticks. So this is what the Consumer Border Protection has come out with, but still we are waiting on a confirmation basically from the administration, because it was supposed to be exempt.
Yeah, it was supposed to be exempt. And again, this is the second metal in the past month where this has happened. Copper getting a surprise exemption. It's a lot of volatility in this market as we learn the details.
If the day ends at Y, you do have some certainty and some volatility. Up next on the program, we're going to set you up for the day ahead, plus Colin Martin of Charles Schwab on why appointing a new Fed chair could be a moot point. You're watching Bloomberg Surveillance.
What's really noteworthy is that at this point, about 80% of companies have beat on revenue. That's new. We haven't seen this revenue surprise in a while. So what that means is that analysts marked down expectations very low for sales and demand, and they're beating those lowered expectations. So I think this all bodes well for a broader market.
That was Savita Subramanian of Bank of America. What you have right now is S&P 500 futures as we go into the opening bell. They are up more than 0.2%, really just treading water, but should come out of the week in the green. Bank of America also put out a note talking about investors are pulling money from U.S. equities and flocking into cash funds. But everyone you talk about say if you see a dip, you should buy it. As we count you down to the opening bell, here's a trading diary for the rest of today and into next week. 10:20 a.m. Eastern, we do have St. Louis Fed President Muslim speaking. On Tuesday next week, CPI data. This is very important. Plus, the current trade truce between the U.S. and China is set to expire. Although the Treasury Secretary did tell me likely there'll be a 90-day referral of that, a pause of that extension. Thursday, PPI and another round of jobless claims. And Friday, retail sales and University of Consumer Sentiment, University of Michigan, that is. Turning to the Fed now, Colin Martin of Charles Schwab writing, the need for a new Fed chair to cut rates could be a moot point. By the time Fed Chair Powell's term is up next year, the Fed may have cut 3 or 4 times. Colin joins us now for more. Is this the irony of all this? The president is really jawboning the Fed and wants to talk about maybe regime change at the Fed. By the time he gets some of these appointments, they've already done what he wants.
I think so. I don't think it's really going to matter, because what we saw with obviously the headline about the weakening labor market now, there was already some support for rate cuts. It seems like there's even more support for rate cuts based on comments from various Fed officials. And the data basically says that if we do get that weakening labor market, and if we look forward to say April, May, June of next year, the markets are pricing in 3 or 4 rate cuts. So even without the headlines of a new Fed chair, who's it going to be? How dovish are they going to be? We might see a Fed funds rate 100 basis points lower than where we are right now. That doesn't mean that the jawboning might end. It doesn't mean that we might not get a new Fed chair who is as dovish as the administration wants, but we have to remember that it's a committee. And I think most committee members, whether it's a governor or a district bank president, They look at their dual mandate, and I think they're more methodical about how they're going to go about it. So even the headlines might not stop, but I think cooler heads will prevail.
Some people have made the point, though, and Paul Donovan at UBS included, that Waller's actually the most dovish pick you could have for a Fed chair because he has credibility with the rest of the committee and could sway them to a more dovish outlook. Is that right? Would a Waller be the most dovish pick over the Kevins, over anyone else?
Based on what we've seen, I don't know if he'd be the most dovish pick, but he's clearly dovish. We could argue he's the most dovish member of the committee right now, governors and district bank presidents. But he's not out there talking about the need for a 3 percentage point rate cut or something like that. If the data were to change, maybe his tune or tone would change. But right now, we're not seeing that. So it seems like he could be in line to be the next Fed chair. There's a lot going on. We have the temporary announcement for Myron because we don't really know what Powell's going to do. So if Powell stays on and Waller's already in there, he could be a logical choice without making too many headlines or without having to worry about the confirmation process.
Well, so when Stephen Myron was announced, the market reaction was slight, but there was one there, a little bit of curve steepening. If you get someone like a Myron or, again, one of the Kevins, a less traditional sort of appointment to the Fed chair, would you put on steepeners? Does that trade make sense?
We think steepeners make sense regardless because we think short-term rates are likely coming down based on the data we're seeing. But at the same time, we have fiscal concerns that likely aren't going away anytime soon. And the idea that inflation might stay elevated. We're not expecting a reacceleration, but the idea that with the tariffs in place right now at relatively high levels, we can see it stay higher than we would have expected if we talked about this, say, 6 months ago. So we think maybe long-term rates stay where they are, maybe come down a little bit, but likely not as much as short-term rates. So I think whoever is in charge of the Fed over the next 6 to 12 months, we think the curve should continue to steepen.
I was talking to Neil Dutta yesterday, and he joined the program this morning. He was talking about the fact that Powell basically holds the cards. If it is someone that seems overtly political, that the Trump administration wants to put as the Fed chair, do you think he stays on?
I don't know. And I say that because it's anybody's guess right now. And I think he's in a really difficult position. On the one hand, he doesn't want to, or I think he does a really good job of not politicizing it because he basically doesn't say much. Anytime someone asks him a question or someone brings it up at the press conference, he just defers and says, we're looking at the data. Now, if there's a push for someone who is, very partisan, very political, and is very loud about the need to cut rates sharply, which the data right now doesn't support, maybe he stays on because his term as governor doesn't end for another few years. But I think he's in a really difficult position because that makes it seem like he's politicizing it, when at the end of the day, I think he's just trying to uphold the integrity of the committee because I really think he's trying to do the best he can.
So you think he's trying to protect the institution, but in the end, if he were to do that, he would end up becoming almost a shadow Fed chair. How could the market deal with that?
That's a great question. I think we just have to understand that, again, there's a lot of committee members. So whether I wouldn't say he'd be a shadow Fed chair. He would just be one other voting member. I think he has the respect of a lot of his colleagues out there.
That's like a senator saying that they're going to run for Congress, for the House.
I think if he was there...
They actually do that,
he'd be a voter. And he would vote based on what the mandate suggests and what the data suggests. We have a lot of time before next May. I think it's going to be a really exciting couple of months.
Well, we have a lot of time, but we have so much information to digest before that time. And this week we had both a 10 and a 30-year auction, and both of them were pretty weak, or at least just lackluster, let's say. Do you look at that and say, okay, this is real concerns about a ballooning deficit and Fed independence, or is it just yields have been lower since the payrolls data, there was less demand?
I'd say all of the above. When we look at the fiscal concerns, which are clearly there, and there doesn't seem to be anyone on either side that wants to fix this right now from in the grand scheme of things. And if we have this, rising deficits, rising debt, we need to find more buyers there. So I think that's one of the reasons why we think yields could stay elevated for a little bit. We're not worried that they're going to shoot significantly higher to, say, 6% levels, 7% levels. But if there are concerns in weak auctions like we got this week, we get the margin, nothing crazy, but it shows that maybe there is a slight pullback in demand. That's another reason why yields can stay elevated when we see a steeper yield curve.
Okay, so to that point, bringing the whole conversation around, if you have an appointment to the Fed that in practice doesn't matter because it's already going dovish, but gives that appearance, especially to foreigners, to seem to be one that kind of chips away at the Fed independence. Does that then matter because it makes foreigners less willing to fund the twin deficits of the U.S.?
I think it would matter. And this is something we talk about a lot, about the idea of Fed independence. We're not worried right now that they're going to lose that. I mean, there's a lot of headlines about it, but we've talked ad nauseum this morning about it's a committee. But that would be a concern for us. You know, if there was a lack of independence, we think we'd likely see a weaker dollar. We think we'd likely see long-term yields rise because of that loss of confidence in the markets. And when we look at what we've seen in the tick data, basically from Liberation Day, initially the first month we actually saw foreign private investors sell a lot of their treasury holdings. That then reversed in May. So we kind of have a cloudy picture right now. We're not really sure what the long-term trend will be, but what that shows us is maybe more volatility, and that in and of itself would result in kind of that higher term premium.
Collin, as we close out the week, what are you looking for next week? Is everything just going to be dominated by CPI?
I think so. I think we'll have to look under the surface. I mean, the headline gets a lot of headlines, but we'll have to see what the difference is between goods and services, and we'll have to see how much pass-through we're seeing in terms of goods, the imported goods, but are we seeing a slowdown in services? Because I think that's the big dichotomy right now.
Collin, thanks so much for your time this morning. Collin Martin of Charles Schwab. Danny, next week, it's going to be all about inflation. We have the weakening labor market. Will inflation cool enough for the Fed to feel like, okay, maybe we can cut in September?
Or to Kathy Bostjancic's point, do we just look through it and say this is a one-time thing and that there are other disinflationary forces in? And was the labor market data we've gotten to this point weak enough that regardless of what we get from the two CPI prints, it's a Fed that's going to look through it? You certainly are hearing speakers like Daly, like Kashkari, Cook start to talk about this idea that we need an adjustment, not outright accommodative, but at least getting less restrictive.
And we're going to hear from Fed Governor Muslim today, so maybe he will join in on the chorus. Coming up on Monday, Cameron Dawson of New Edge Wealth, former senior White House trade advisor Kellyanne Shaw, Peter Oppenheimer of Goldman Sachs, and David Leibowitz of JP Morgan Asset Management. That was Bloomberg Surveillance. Thank you so much for joining Danny and myself. Don't worry, Jonathan Farrell will be back with you on Monday morning. Have a lovely weekend.
Day one at the Cincinnati Open. Living legend Venus Williams says she still plays tennis for the love of the sport, and the seven-time major champion felt the love of the fans in her opener against Jessica Buses-Monero. It may not have been a winning start for Venus, but just to see her back on court was enough for the crowd in Cincy. And don't forget, you can watch all the action live daily on Tennis Channel.